Chapter 13, we're going to get started now. This is the first of 3 chapters in talking about mortgages and financing. So, chapter 13, mortgages. Everybody there, page 225. This chapter, we're going to be able to describe the provisions of a note, what is a mortgage and a trust deed, explain various methods of satisfying or transferring a mortgage, including the process of foreclosure. There's 2 parts of every mortgage: the mortgage itself, which is a security instrument, and the note, which is the financing instrument. What do I mean by that? Well, a note or bond is the financing instrument. See, we don't use bonds in New Jersey, we use notes, but they do the same thing. The bond does the same thing as a note. It's the financing instrument that lays out all the terms of you borrowing that money. It lays out the interest rate, the terms of repayment, what the monthly payment is, how many months of repayment, how many years of repayment, at what interest rate. It's the note that makes the borrower personally liable for the entire amount borrowed, the entire debt. So the note is what holds that borrower liable for that full amount, even in the event of foreclosure. So if you get foreclosed on and you still owed that bank money, they could come after you for a balance. If you do a short sale and you did not negotiate them to give you a satisfaction of lien, meaning that it's going to be paid settled, that they're not going to be chasing after you for the balance, they could still chase after you for the outstanding balance from the shortfall that they're still owed. So that's why we usually negotiate a satisfaction of lien when we're doing short sales as well. So the note is what makes the borrower liable for the full amount borrowed. Okay. Now the mortgage itself is a security instrument. It is the pledge or promise that the borrower makes to the lender that says, I promise to pay you if you lend me this money. And then it further goes on to say that if you lend me this money, I will pay you back according to the terms in the note. And if I fail to do so, you can foreclose on me to regain ownership of the property, because foreclosure is the legal process of regaining ownership of a asset put up for collateral, in this case, the house, in exchange for the loan. And you could sell the property at auction and use the proceeds to pay off the debts. That's what the mortgage, that's the promise. Remember, I keep telling you a mortgage is a promise to pay. Well, that's what the promise says. If I fail to pay you back according to the terms in the note, you can foreclose, sell the property at auction, use the proceeds to pay off the debt. Okay, so those are the 2 parts of a mortgage. Which one's the financing instrument and which one is the security instrument?
The note is the financing instrument, and the mortgage is the security.
All right, that could be a question on exam in itself. Hint, hint. All right, so the notes, the financing instrument. Okay, so this is all the same stuff we just went over. So the mortgagor ends in OR. What happens with words that end in OR? That's the person who's giving whatever the root word is. And what is the mortgage? It's a promise to pay. So who gives the promise to pay?
The borrower.
The borrower does. The owner of the property, the borrower, gives their promise to pay. In exchange, the lender, the mortgagee, lends them their money. Hypothecation, upper crusty sounding word there, right? It's hypothecation. All right, well, that's a pledging of property as security for a loan without actually giving up the property. What does that mean? Well, you know, if you ever go to a pawn shop because you need money or something, so you want to pawn something, an expensive item you have, you could take it to a pawn shop and they'll give you money for that item. and you could still come back and recoup that item that you gave them to hold on to. Okay. If you don't return and pay them back in a certain amount of time, then they'll just sell it and get their money back. So this is a little bit different than a pawn shop, because a pawn shop, they're holding your property. With hypothecation, you're just pledging the property without actually giving it up to them. You're actually going to be living in the property because the property is your house. Okay. So a mortgage is an example of hypothecation. So let's highlight: a mortgage is a pledge of property that serves as security or collateral for the debt or the loan, on page 225. Then we're going to highlight in the number 1, a note is the financing instrument. And in number 2, we're going to highlight the mortgage itself as a security instrument. Then we turn to the next page, 226. And in the second paragraph, we're going to highlight on the end of the first line, the mortgagor is the borrower. Who's the mortgagor? The borrower. Right. Then they talk about hypothecation. I'm not going to have you highlight it because you'll probably see it on exam, but as a wrong answer option. So don't worry about it. They use real words, but I doubt they're going to ask you any questions about hypothecation. All right. Trust deeds. We don't use them in New Jersey. Okay. Note, New Jersey is a judicial foreclosure state, so we do not use trust deeds. Trust deeds is like a third-party system where a lender can gain possession of the collateral a lot simpler, because it's like a three-party system. A neutral third party holds on to the deed, and if you don't pay them back, they just give the deed to the lender. So it doesn't have to go through the whole court system. So it happens a lot quicker. But New Jersey, we have a judicial foreclosure system. So in order for a lender to obtain that collateral, they need to go through the courts. Okay. So trust deeds or deeds of trust convey the real estate as security for loan. The trustee, the neutral third party, holds on to the deed so that they can give it back to the lender without going through the court systems in the event that the borrower is not paying it, not making their payments, right? So foreclosure is a lot easier process when you have trust deeds in place, but we do not use that in New Jersey anyway. So boom. Notes. We use notes here. So what is a note? A note is executed by a borrower at closing. What does executed mean?
Completed.
They signed it. Okay, so it's executed, meaning they signed it. It's signed by the borrower at closing. The amount of the debt borrowed, the time and method of repayment, the term, these things are all stated on the note. The rate of interest, it's signed by all parties who have interest in the property, and it's what makes the borrower personally liable for the entire debt. The note is the financing instrument, right? So what are some of the provisions of the note? Well, before we go over the provisions, so the mortgage document refers to the terms of the note and clearly establishes that the land is security for the debt. It defines the lender as well as it identifies the lender as well as the borrower, and includes an accurate legal description of the property. It should be signed by all parties who have an interest in the real estate. It also sets forth the obligations of both the borrower and the lender. Now, default means that one of the parties is not holding up to their end of the bargain. They are defaulting on the agreement. Generally, a borrower that is in default, the lender will give them 30 days to cure any default. So, according to the provisions of the mortgage document, what is the duties of the borrower? What are they obligated to do to not be in default? Well, the mortgage document is executed by the borrower. It has a legal description, identifies the property pledged as security for the debt. It identifies the lender and the borrower, should be signed by all parties, identifies the obligations of the borrower, and it identifies the rights of the lender. So if any of these duties or requirements of the mortgage contract are not carried out, the borrower is in default and the lender could foreclose. Before a lender forecloses, they'll generally give the borrower a 30-day leeway to cure any default, or at least a 30-day leeway to cure any defaults. So when is a borrower considered in default? Well, what are their obligations? Well, if they don't do any of these things, they are in default. They're required to repay the debt according to the terms in the note. Okay, everybody knows that, right? You got to pay your mortgage. If you don't pay your mortgage, you're in default. They also have to pay all the real estate taxes on the property. Why? Because if they don't pay them, well, then there could be a tax foreclosure, and that could even wipe out a first lien holder. So that lender has to make sure that you're paying your taxes. Maintain property insurance, because if the property burns down, what happens to the collateralized property? You know, its value goes down and the lender can't recoup their money. So one of the obligations of the borrower, the mortgagor, is that they got to maintain property insurance until that loan is paid off. They must obtain permission before doing any major repairs on their own home. Bet you didn't know that one. You know, why is it that the lender wants you to get their permission before doing any major repairs on the house? Well, what's the first step when doing any construction other than getting permits? Say you want to remodel your kitchen. What's the first step other than the permits?
I was gonna say permits, but thinking of a different option now.
You got to gut it. You got to gut
Okay.
it, right?
Yeah.
You got the kitchen before you remodel it. You got to rip out all the old stuff. Okay, so let's say you rip out all the old stuff. And now you lose your job. Is your first priority to finish the kitchen?
Nope.
No, it's how am I going to budget my money? Right? You're not thinking about doing construction right now. You're like thinking about how am I going to pay my mortgage bill, right? And what happens if it gets to the point that you need to get foreclosed on? What is the lender getting back? They're getting a house without a kitchen. Very difficult to sell a house without a kitchen. It's going to drastically reduce the value of the collateralized property. So before you could do any major construction projects like that, the lender wants you to obtain their permission. Then they're going to want to see the plans. They're going to want to find out a list of all the contractors that are going to be doing the work. And they want to see where you're getting the money and that you have the money to complete the project. Otherwise, they're not going to want you to start a project that you don't have the money to complete, right? Otherwise, you're going to end up like probably one of your friends. I'm sure we all have friends like this, if it's not you yourself, that have their home perpetually under construction. They got these little projects going on all the time, but it's like never done, right?
Yeah.
All right, so you have to maintain your property too. That's one of the duties of the mortgager. Maintain your property, keep your grass cut, keep the property in good condition, you know. I mean, how many houses we see out there with gutters falling off, the paint peeling off the house, overgrown grass, you know, these are all things that could risk the collateralized property. Well, they're definitely devaluing the property if you're letting it crumble and fall apart, right? And if you're letting the grass overgrow and stuff, that's an invite for rodents and other health hazards and issues with the city too, who can fine you, the homeowner, or the lender if they end up foreclosing on the property for not maintaining the property. You have to secure permission before adding any second mortgage within 30 days of getting the first one. This way, the first lender can make sure that they register in the public record their first lien position order. And so in the event of foreclosure, they're the one that has the priority. So here are some provisions for default and other clauses in the mortgage. So under provisions for default, next to the title, I want you to write this: first step in foreclosure. Next to provisions for default, you're going to write first step in foreclosure on page 227. Next to provisions for default, write first step in foreclosure. And then highlight the words alienation clause to assist the lender in foreclosure. And then underneath the paragraph, you're gonna write, before this, a lis pendens is recorded, right? Because even before they start foreclosure, what's the first step? Even before the first step of foreclosure, when you're just being late on your mortgage payments, they file a lis pendens in the public record to place the world on notice, and if any interested parties, that possible future legal action is pending. That legal action being foreclosure. So what is the acceleration clause? What does it do? It assists the lender in foreclosure that allows them to accelerate the terms of the debt, that all of the payments are now due and owing immediately. I had my ringer off. I don't know why it's ringing right now. Somehow my volume went back up. All right, so that all the payments are due and owing immediately. So the acceleration clause, what does it do? Is that it accelerates the terms of repayment. So when you fall behind on your mortgage payments, they have to do their collections. They try to get you to make your payments. But before they could start foreclosure, they have to declare that the entire debt is due and owing now. Can you pay it? No? Well, then we're moving forward with foreclosure. Okay, next, under other clauses, we're going to highlight in the second paragraph there, the defeasance clause ensures that when the debt is repaid, the mortgagee, that's the lender, has no further claim on the property. So defeasance clause kind of looks or sounds like defeated, defeasance, defeated, defeasance, defeated. When you've defeated that loan, you've paid it off, you've defeated it, the defeasance clause, you defeated it. The lender has no further claim on the property because you don't owe them anything anymore, right? So when the debt is repaid, the loan has been defeated. So the defeasance clause states that the mortgagee has no further claim on the property, and this is what requires them to go back and add another document to the public record called the satisfaction of lien, so that anybody who searched the public record can see that the loan is no longer out there. See, when you pay off your loan on the house, they don't remove the lien from the house. That lien is always in the public record forever now. Anytime we add a document to the public record, it's there forever. All they do is they just add another document that says that that lien had been satisfied. So they call that a satisfaction of lien. Make sense? Okay. So what happens if the lender kind of mixes up their records? What happens if the lender forgets to record the satisfaction of lien and you never followed up on it?
It still shows up as like unpaid.
It still shows that there's an outstanding lien on the property. You know, I know this girl, she tried selling her house not too long ago. She tried selling her house, and when she went to go sell the house, the buyer did a title search, of course, and it did not show only her loan outstanding on the house, but it still showed the loan outstanding on the house from the person she bought it from. Their lender never filed the satisfaction of lien to show that the loan was paid off when she bought it. But that's what her mortgage loan was for. It paid off the existing one. Okay. But because they didn't show that in the public record, you can't prove it. So you need to have that. So how do you fix that problem? How would you fix that problem?
Contact the lender.
Contact her lender, the lender of the guy who she bought it from, to get them to file the satisfaction of lien? Is that what you're saying?
Yeah.
Well, that sounds like good common sense thing to do. But
What about your attorney?
what do you do when they went out of business?
Ooh.
This is what happened to her.
What about your attorney?
What about him?
In the closing statements, don't they, or wouldn't they notify or make sure that's part of the agreement, or make sure at least
She
you have
didn't.
it?
He didn't.
Should be some sort of check or something that she paid off, or whoever paid off the, debt on a mortgage.
Well, that comes out from the proceeds from the sale. Whoever the closing agent is was supposed to handle that. And then you got to follow up. It's one thing that they're paid, but then they need to report that it was paid. Okay.
Mhm.
But okay, so you have the closing agent didn't do their job, and then the bank didn't do their job. Now what? Now we got a problem. Right?
Yeah.
Well, a lot of people get a lot of people get title insurance too to fix these problems. All right. Let the title insurance company deal with it. So she bought title insurance. She paid for that when she bought the house. Oh, one little problem. When going through all of her paperwork from when she bought the house, she can't find the paperwork for the title insurance, but she knows that she paid it to the attorney. She contacted the attorney, told him about the problem that she's having, and she wanted his help to fix it. You know what he told her? That's your problem now. She's like, wait a minute, I paid you for title insurance. Guess what? He never bought it. Put the money in his pocket.
Oh.
So what do you do? So what do you do now?
Sue him.
Sue him. Good idea. I advised her the same thing. She couldn't find an attorney willing to sue her attorney because he's now a New Jersey Supreme Court justice.
Holy shit. What a
Okay,
mess.
So now what do you do?
you still go through proceedings. I mean, I don't know. I guess you still try to sue him.
Well, you could try to hit the attorney where it hurts and file a formal complaint against them with the Bar Association that manages the licenses for all attorneys. Do you know that if an attorney gets, I think, 3 complaints on them against with the bar, their errors and omissions insurance goes through the roof. So their insurance becomes extremely expensive. But the only thing is, do you know they charge you to file those complaints against the attorneys?
No.
It's about $3,000 to file a complaint. Just to file a complaint.
Oh, they
It's
make
a
it
They're
hard.
protected
So
just
she
for
was
that.
like, I'm not gonna be doing that. Okay, so what's your other option? Well, you could reach out to the state attorney general. If you get no satisfaction there, reach out to the national attorney general of the whole country. Because this is wrong. You got an attorney who's now a judge who basically committed fraud. They stole money from you, and nobody's willing to go after them. No attorneys, because they're scared, because at some point they know that they're going to have to plead a case in front of this guy, possibly, and that ain't going to pan out very well for them. So you got some intimidation there going on too. She tried to go to him to help, and he basically said, screw you. I don't know how she ended up curing up the problem, but it took over 2 years to do it. So what do you think happened to her sales transaction there? That sale died. went back on the market, found another buyer, had to explain to him what's going on and that it's going to take a while because they're still working on curing it. So it took about 2 years before she got it cleared up, the problem. I don't know how she went about doing it, but she got it cleared up. Took about 2 years to do it. And then she finally sold the house.
Wow.
This could be a very important step here, huh?
Yeah.
Now, when you pay off a mortgage, you got to make sure that that gets reported, that the lender does what they're supposed to do and files that satisfaction of lien in the public records. And the person who sold the property, the person that bought the property, it's in both of their interests to make sure that that got taken care of. There's also other possibilities for certain things happening. And you want to make sure that things like this could occur when lenders don't do what they're supposed to. Hold on.
This morning from Philadelphia. Hey, Patrick.
Hey, how are you?
I'm doing well. So explain this for us. You actually had a home that Wells Fargo came to you and said, look, you need to take out a homeowner's insurance policy that you don't think it's worth the value.
By the way, I think this guy thinks he's Dracula or something. Check out his fangs.
Of your home. What did you do to Wells Fargo in response?
I told them I wasn't going to renew that policy that they were having me renew. I had an insurance policy on my house, which I had bought for $180,000. And Wells went to the insurance company and said that they wanted me to insure it for $1 million. And as you can imagine, the premium on a policy like that is through the roof.
Okay, this was a different reason for foreclosure. Basically, he had a loan with the Wells Fargo, and Wells Fargo wanted him to increase the insurance on their collateral, which is the property, to $1 million. And he's like, my home's not worth $1 million. Why am I gonna pay $1 million? The insurance on $1 million is significantly more expensive than my regular insurance. And they tried to foreclose on him, but instead he changed it around a bit.
So I said, no, I'm not going to do it. And they said, well, we're going to do it for you. And they force placed an insurance policy for me that doesn't cover me. It only covers them. And that was the genesis of a dispute with them that's been running for nearly 2 years now.
Well, we did reach out to Wells Fargo, got no response from them. It sounds just like your experience with them, no response at all. Are you surprised by
Welcome to the
that?
world of dealing with Wells Fargo. No, I'm not surprised at all.
You also then found an interesting loophole, or not a loophole, but you found an interesting law dating back to the 1970s, which enabled you to work this angle, which is they needed to respond to you within 20 days. They needed to respond to you with written responses to your inquiries. They didn't do so, and therefore you were able to place a levy on their office and foreclose on them?
That's true. There's a law called RESPA, and there's a 20-day window that they have to acknowledge receipt of your request. And then they have 60 days to actually respond to that request. And if they don't, it's possible for you to collect damages and even additional fines on top of the damages. So I took them to court here in Philadelphia through the municipal court system. I won a judgment. They ignored the judgment. The court advised them they had to pay. They ignored that court's advice. And so I got a sheriff's levy. And when they ignored that, I ordered a sheriff's sale on their branch in downtown Philadelphia. And they still weren't going to pay. But let me tell you, when the media coverage started and it was on the front page of the business section that their office furniture was going to be sold off to pay a judgment, I had a check in my hands the next day.
Brilliant. And I can imagine a lot of viewers this morning waking up wondering if they're in a similar position. Do you think that your story opens the floodgates for other people watching this morning?
I think it does. I mean, people ask me what I hope to get out of this. And one thing is, if I wind up being the Johnny Appleseed of RESPA letters, I would absolutely love for that to be my epitaph. These RESPA letters are not difficult to write. There are numerous consumer resources sites on the internet. There's government sites on the internet that'll help you with that process. And these RESPA letters, the banks are legally required to respond to them. So I would say to consumers, these are a very important tool if you're having a problem communicating with your mortgage lender.
Patrick Rogers from my home city of Philadelphia, good luck to you. And
there are a lot of regulations when it comes to lending. And one thing he's talking about is RESPA, which we're going to be learning about today. RESPA is the Real Estate Settlement Procedures Act that requires a lot of disclosures to the consumers. So the consumer is required to be aware of every penny in the closing process. We have the RESPA closing statement, which informs both the buyer and seller of where every penny, it has to account for every penny in the real estate transaction. And then it also requires the lenders to give the borrowers disclosures within certain time frames. There's something like 300 different disclosures that they need to give, according to RESPA and TILA, the Truth in Lending Act. And if they don't give all of these disclosures to the borrowers, there are possibilities that the borrowers can sue the lenders or have the lenders cancel the debt even, depending on what it is. You know, it's knowing the law is always good if you want to win a battle, right? Because a lot of times the banks, the lenders, they think they're too big for their britches. You know what I'm saying? If you know what your rules are, if you know what the rules are, you could always go after them to try to light a fire under their butts like this guy did. You know, let's give you that other example. Let's see, where the guy foreclosed on the Bank of America.
As a foreclosure defense attorney, sweet justice.
Only on Wink tonight, the tables are turned. Instead of Bank of America foreclosing on a home, a homeowner has deputies foreclose on the bank.
Bank of America filed foreclosure papers on a homeowner who didn't owe a dime. They paid for their house with cash.
Renee Stoll live at the Bank of America branch on Davis Boulevard in Naples. With this story, you'll see only.
So what happened here is, let me just clarify this. These people bought a bank-owned home from Bank of America, but they bought it all cash. They never got a loan on it. Now, Bank of America saw that they had a home that was sold to these people, but they could not locate any payments from these people, I guess. So they figured they weren't making payments on their loan, so they foreclosed on them. Now, that's a lot of figuring without having any evidence. You're not supposed to foreclose on anybody because you're figuring, you're guessing.
On Wink tonight.
This is about a family who fought back and won. Their foreclosure nightmare started when they bought a house in the Golden Gate Estates owned by Bank of America. Like you said, they paid cash, so they never had a mortgage. Well, Bank of America fouled it up somewhere along the lines and actually tried to foreclose on the family. What happened today, you're just going to have to see to believe. Movers, a truck, and an armed deputy, all while a nervous homeowner stands by and waits. This is normally what you'd see when a person's being foreclosed on and their property seized by a bank. But today, it's the other way around.
They've ignored our calls, ignored our letters. Legally, this is the next step to get my clients compensated.
A Collier County judge said Bank of America had to pay Maureen Nairges and her husband's legal fees after the bank tried to foreclose on their Golden Gate Estates property, but they paid cash. The courts agreed they never had a mortgage to begin with. After more than 5 months, the bank still hadn't paid up. So the homeowner's attorney did just what the bank would do to get their money: seize their assets.
I instructed the deputy to go in and take desks, computers, copiers, filing cabinets, including cash in the drawers.
Outside the bank, several deputies stood by with movers ready to start hauling out the bank's office supplies and furniture. Inside, the homeowner's attorney was locked out of the bank manager's office by deputies, while the bank manager tried to figure out what to do.
He was visibly shaken. Having two sheriff's deputies sitting across your desk and a lawyer standing up behind them, demanding whatever assets are in the bank, it can be intimidating. But so is having your home foreclosed on when it wasn't right.
After about an hour, the bank finally cut a check.
As a foreclosure defense attorney, sweet justice, because this is a symptom of a larger problem.
Now, the homeowner's attorney says that he sees mistakes all the time in foreclosure court where banks do not do their due diligence, and it winds up becoming a very lengthy process for the homeowners. He says he can only think of one other time where an attorney, the deputies, and a U-Haul came to a bank before ready to seize property that was in Tampa. As far as Bank of America, they issued a statement saying that they apologized for the wait on the payment. They issued a notice to pay from the attorney that was working on the case on their side, but they didn't know the attorney went out of business. We'll be reporting live here in Naples. Renee Stolwink News now.
All right, Renee, thank you.
That's wild.
There's humans involved. Like you said, in here, we got the bank screwed up, and then they realized that, and they issued a notice to pay, but the notice to pay was given to their hired attorney, but the attorney went out of business, so it was never paid. And then they go and they tried to communicate with the bank, and they still don't do anything. So what's the next step? Foreclose on the bank. Interesting, right? Thought you guys would get a kick out of that. All right, let's get back to the slideshow. All right, so the defeasance clause requires the lender to file the satisfaction of lien when the loan is repaid in full. All right, so we highlighted that under other clauses. All right. Now, an estoppel certificate under assignment of the mortgage, in the second line, I want you to highlight an estoppel certificate is executed by the borrower that verifies the amount that remains to be paid and the interest rate. So what is an estoppel certificate? Well, often when you go and you get a loan to buy a house, how does lending work? We got to talk about that a little bit. Well, you go to the bank to get a loan. That lender writes a loan with the intention of usually not holding on to that loan for the full term of 30 years, which is the common loan. Basically, they lend you the money, and then they have the intent to resell that loan to an investor on what is deemed the secondary market. This is secondary market is where investors buy loans from banks, and then they hold on to them for the term of 30 years or whatever it is. And then they collect all the interest along with the repayment. That's where they make the big money. So your local lender, they make money by originating a loan to the borrower and then reselling it to an investor to get some of that interest paid right away to them. And then they sell that loan to this investor. That investor will often not do their own collections. They'll often also pay that local lender a servicing fee to continue collecting the monthly mortgage payment. But before they buy that loan from the local lender, they need to verify what it is that they're buying from the lender. In order to do that, they want the borrower of the loan, the one who made who borrowed the money, to confirm all of the details that the bank is saying about the loan that they're trying to sell to this investor. They want the borrower to confirm what the original loan amount was, at what interest rate, what's the monthly mortgage payment, and the term. All right. And they do so in a document called an estoppel certificate. Now, it may not say anywhere estoppel certificate on there. It could just be your monthly bill, but they want the borrower to sign off on that to confirm the terms. So sometimes if you're making your mortgage payment, you're actually doing that. You're confirming those terms by making the payment. So that's what the estoppel certificate does. Now, that investor's also going to want the bank that's selling them the loan to confirm that same information. And when they do that, it's not called an estoppel certificate when the bank signs it. The document that the bank signs confirming the same information on the estoppel is called a reduction certificate. So a reduction certificate is the same exact thing as an estoppel certificate, except it's signed by the lender. So an estoppel certificate is signed by the borrower. The reduction certificate is signed by the lender. Both of these documents just confirm the amount of the loan, the interest rate, the monthly payment, and the term. It just verifies the terms of the loan. Okay, so let's write underneath that paragraph where it says estoppel certificate, let's write Reduction certificate is the same thing as an estoppel, but signed by the lender. Reduction certificate is the same thing as an estoppel, but signed by the lender. And then I give it a little cross-reference, page 229. It's the same thing. It does the same thing as the estoppel certificate, but it's signed by the lender. Okay. Everybody get that yet?
Yep.
Okay, so other clauses. Okay, so the note's a negotiable instrument that may be sold by the lender. Assignment of the mortgage, you get a satisfaction of debts filed by the lender once it's been repaid, and recording of mortgages in the public record need to be done. That establishes the priority of liens. Okay. Usury. Okay. What is usury? Let's write next to it illegal. Prevents loan sharking. Excuse me. Usury is illegal. Usury laws prevent loan sharking. So usury only applies to private lenders, not institutional lenders. When you, as a private party, like a homeowner, if you're going to give me seller financing as an example, or if it's a commercial loan, which is considered a private, it's not an institutional lender, it limits how much you could charge me in interest. It prevents charging an illegally high rate of interest on the loan. Okay, that's what usury is. So you need to know that for exam. This is always on exams. What is usury? Laws to prevent charging an illegally high, or it's charging an illegally high rate of interest is usury. So we have usury laws in place to prevent that. Okay. If you guys want to learn about how borrowing and lending works and usury and all these terms, there's a great video. It's a series called Money as Debt, Promises Unleashed. It's about a 42-minute video made into a cartoon that's narrated by this economist guy. And it's really entertaining. I think even kids, when they're in high school, should be mandatory watching it. It shows you how money gets its value, how the monetary system works in the United States, and it educates you all on it, all about it in like 42 minutes. You know, I think it's an awesome video to watch. Let's see. New Jersey real estate. Okay, let's see. So what is considered usury in New Jersey? Sellers may charge no more than 16% on their first mortgage, but they could charge as much as 30% when they're selling their primary residence. Wow, 30% is considered not to be usury. Well, you know, the interesting part is usury laws do not apply to institutional lenders. That means they could charge as much interest as they want. What is an institutional lender? Any lender that is in any way, shape, or form related to the federal government, meaning that their depositors' money are insured by the FDIC or FSLIC. They have loans that are guaranteed by the VA or insured by the FHA. They're planning on reselling those loans to any institution that's in any way related to the federal government, or they're insured by the federal government. So interesting. So basically, the government does not need to follow the same rules, is what they're saying. Okay, now, so we highlighted usury is charging an unreasonably high rate of interest is known as usury. And then you wrote next to that, it's illegal to prevent loan sharking, right? Turn the page. Nothing to highlight here, but check this out. Here's another reason to want to abolish the IRS, right? If you're lending me money to buy your house, you're doing seller financing, you know, we got usury laws that prevent you from charging too high of an interest. But if you charge me too low of an interest, the IRS can step in and impute a higher interest rate that they could tax you on so that they could get their fair share of your money. So you want to charge me a low interest rate? Well, the IRS may have something to say about that because they make money off of charging you interest on loans, right? All right, or taxes on interest on loans, and they want to get their fair share. So, and this does not apply to rich people. This applies to transactions of $2.8 million or less. So lenders must charge at least 9% or an amount equal to the applicable AFR, whichever is lower. And right now it's being artificially held lower since the mortgage crash of 2006-07, right? All right. Now, New Jersey does not allow prepayment penalties. Prepayment penalties are not allowed in New Jersey. So let's highlight under prepayment. This is always on exam. Under New Jersey law, this is the last sentence under prepayment. Under New Jersey law, an institutional lender may not impose a prepayment fee or penalty if the mortgage is paid off earlier than was originally planned. However, private lenders can, okay? But let's forget about that. Let's just study for exams. No prepayment penalties allowed in New Jersey, even though we know technically there is a situation where they can charge prepayment penalties, and that's for a private lender or commercial loan, okay? But what do we need to study for exams? No prepayment penalties allowed in New Jersey. You get any question on it, they're not going to try to trip you up. No prepayment penalties allowed. Although technically that only applies to institutional lenders, okay? Got it. Now, first and second mortgages. Let's see. The lien order of repayment of mortgages in the event of foreclosure is based on the priority of when it's recorded in the public record. Now, sometimes you may want to get another loan, but you can't get that loan unless your primary lien holder agrees to allow the new loan, which is smaller than theirs, to jump ahead of theirs. Now, why would they allow that to happen? Well, sometimes they would allow this to happen when you're getting a home improvement loan, because the home improvement loan is only going to improve the value of the property, which is the collateralized property anyway. And that second loan is much smaller, that if they allowed it to jump ahead of them and they needed to get to foreclose on because they weren't getting paid back, that loan is so small, it would not wipe out the primary lien holder if they drop back in the lien position, right? So, and what do we call the document that allows a junior lien holder to jump up, or to a primary lien holder to drop back in a lien repayment order to become subordinate of another? Subordinate means under another. It's called a subordination agreement. So a subordination agreement allows a first lender to drop back in the lien repayment order, okay? Nothing really to highlight there, but yeah, I don't think there's one liner there for you to highlight, but I don't think you're going to get a question on it anyway. But just in case, I have it here. Subordination agreement. It's when, just look at the word sub. What is sub? Like a submarine. It's under the water. Sub, under the surface. Subordinate. If you're at work, the boss has subordinates. Those are everybody who works under them, right? So a subordination agreement would be the agreement. See, you could figure this answer out just by thinking about it like that. So if you, no matter if you get a question on it, subordination agreement would be the, what we call the agreement that allows primary lien holder to drop back in the lien repayment order, becoming subordinate to another. Okay. We already learned that a satisfaction of mortgage lien is the document that is added to the public record by the lender when the loan had been satisfied. When what occurs, do they do that? When does the lender required to file a satisfaction of mortgage?
When it's paid off, when it's completed.
All right, and what clause in the mortgage requires that? What do we call it when you've paid off the loan, when you've killed that baby? You have done what?
Executed.
You've defeated it.
Okay.
And when you defeated the loan, sounds like defeated? The defeasance clause.
Defeasance clause.
There you go. Okay, so I'm trying to bring it all back so into a story so you guys understand it. Okay, so the defeasance clause is what requires the lender to file the satisfaction of lien. The defeasance clause says the lender has no further claim on the property. Okay, so documents recorded in a public record by the lender stating the lien has been repaid in full. The lender has no further claim on the property. You know, we could add, let's add that back into the slide here though too. Let me see what slide is this. Other mortgage activities. There we go. I'm going to add another line there in that slide that says the defeasance clause is what requires the lender to file the satisfaction of mortgage in the public record. Okay. What slide is that? 17. Let me just make sure I spelled defeasance wrong. Or right. Defeasance, D-E-F-E-A-S-A-N-C-E. Defeasance. I believe so. Just make sure here. Hold on a second. Yep, I got it right. All right, there we go. So I updated a little bit. The defeasance clause is what requires the lender to file the satisfaction of mortgage lien in a public record. So I just added that other line there. Okay. Now, when you're assuming a mortgage loan, that means that you're taking over somebody else's payments on the loan. The primary mortgagor, that's the borrower, never gives up their liability. Well, when you assume anything, whether it's a loan or whether it's a lease, the primary person in the contract never is relieved of their liability, right? All right, let's go to, so let's highlight under satisfaction of mortgage lien, the first two lines at the bottom of page 228. It says when all the mortgage payments have been made and the note paid in full, the mortgage lender is usually required to execute a release of mortgage or satisfaction of mortgage. Now, alienation clause, also known as the due on sale clause, another thing that you need to know, you'll see on exams. Let's highlight alienation clause, and right next to it, next to the title, even though it says it there in what we're going to be highlighting, I want it next to the title so it stands out to you. Alienation clause, I want you to write next to it, also known as the, or just right next to it, due on sale clause or slash due on sale clause. Alienation clause slash due on sale clause, and write it just like this, due on sale clause. That could be a question just in itself. What do we call The alienation clause is also known as the due on sale clause. The due on sale clause is also known as the alienation clause, okay? That could be a question in itself. So what is an alienation clause? The alienation clause, the purpose of it, it's in the note. It can be found in the note. The purpose of the alienation clause is that when ownership of the property transfers from one person to the other, if there's a mortgage lien on it, that loan needs to be paid off in full. It's due on sale, right? So all the payments are due on sale. So when the loan is due on sale, anytime you transfer ownership. What is the purpose of this? They don't want somebody taking over your existing loan, especially if it's at a lower interest rate. They want the new borrower to get a new loan at hopefully what is a higher interest rate at the time. Now, if they got a high interest rate on the loan and interest rates today are low, well, they may be okay with you just assuming that loan. You'd have to check with the bank though, because they have that clause standard in most loans these days. The alienation clause prevents it from being assumable. But is everything absolute, or could you speak to your lender and see? You can speak to them and see, okay? But if you don't speak to them and see, well, by default, you cannot just assume someone else's loan these days because they have that alienation clause. What does the word alienation mean? We learned about this in chapter 5. Its simplest definition is it's a transfer of property. So why would we have an alienation clause in a mortgage loan? To say when you transfer the property ownership, the loan is due on that sale, right? So when you sell it, it's due. Alienation is transfer of property when it's relating to a loan. Why would they care about that? A transfer of property and a loan? Well, because they want to make sure that you paid it back. Okay, so let's highlight the title, alienation clause. You wrote next to it, due on sale clause, and then highlight when the real estate loan is made, the lender wishes to prevent some future purchaser of the property from being able to assume that loan. On the next line, highlight alienation is also known as the resale or due on sale clause. And then turn the page. So how does foreclosure work? Well, in this slide, I got just the details drawn up here for you. So when the borrower defaults in any of the obligations of the mortgage, this may result in foreclosure. The lender typically gives the borrower 30 days to cure any defaults. Then a lis pendens is recorded in a public record, which is a public notice of possible future legal action against the property owner, that legal action being foreclosure. Foreclosure is the legal process where a lien holder, the lender, takes ownership of the property through the court action, which has been pledged as collateral for the loan. It's the first step of starting the foreclosure is enacting the alienation clause in the note. So the lender could ask the court to order a foreclosure auction, sheriff's sale. But before a sheriff's sale can take place, all interested parties, including the renters, need to be made aware that a foreclosure is in progress. Let's stop there for a second. That often causes problems for a homeowner, because you could get a homeowner who's behind in their mortgage payments, and it could be for legitimate reasons. Maybe they had medical bills that piled up or whatever, and they're going to get caught up, and they could get caught up still. But when they order that they have to send out this notice that this possible future foreclosure may be coming, and that notice goes to the tenants, tenants often get this attitude about them. Well, if they ain't paying their bills, why should I be paying mine? They're going to be losing the property anyway, right? That causes major problems for the homeowner. Now the homeowner who had the possibility of getting right with their mortgage, now they just put the death nail in their coffin, because if the tenants are not paying the rent, they made it that much harder for the landlord to get their head above water and caught up on their mortgage payments. Even though they could have gotten caught up still, now if the tenants stop paying rent, it's definitely going to get foreclosed on, because there's no way for that landlord to get that money to do so. So I advise landlords, if they're in this position, to immediately start eviction proceedings on those tenants. They still have an obligation to the landlord. They got a contract with the landlord to pay their rent. You're living in their house, you need to pay the rent. The owner's finances are none of your business. So you not paying the rent because the landlord's not paying their bills, that is none of your damn business. You now not paying your bills, well, that's an issue now between you and the landlord has the right to evict you. And I suggest that they get started on it lickety split, right? That'll light the fire on your butt to start paying your rent and your obligation. Otherwise, it's a hopeless situation here. Okay, so before a sheriff's sale can take place, they got to notify the tenants, and then it needs to be advertised in the local newspaper for at least 4 weeks in the local newspaper in the county where the property is located, and in the newspaper in Trenton. The sheriff's auction is then scheduled. However, that sheriff's auction can be delayed twice by the borrower for 2 weeks each time. That's how long? Twice for 2 weeks each time? That's 1 month. And then the mortgage, the mortgagee, the lender, can also postpone it twice for a total of 2 months. Wait, could that give us enough time to list their property and sell it?
Yeah.
Yeah, but we're on a tight schedule. I mean, how long does it usually take to close on a property? About 2 months.
A month. Yeah.
So if we find out, if we're going in for a listing and we find out, first thing we should ask, do you have a sheriff's sale that's scheduled yet? Okay. If it's not scheduled yet, don't go calling the lender to try to postpone it. Okay. Wait until it gets scheduled, and wait till that day gets closer to the day of the actual sale, and then postpone it on that day. This way you're buying as much time as you can for that owner to try to sell the property still. It is possible to still sell a property even if a sheriff's auction is scheduled. We just postpone it. This is why if you guys ever went to a sheriff's sale, all of a sudden last minute a property was taken off the auction block, it's because they did possibly a postponement. Okay, the lender or the borrower did a postponement of that sale, trying to buy more time. Now, at the auction, any bidders have to pay cash, at least 20% at the auction. And then the balance must be paid within 10 days of the auction. Otherwise, they forfeit the 20% they put down. After that 10 days, that's when the sheriff's department will deliver the deed for the property and to the successful bidder, and that's when they become the owner. However, if we sell the property even after the auction, we have until that deed is delivered, that up until that 10-day after the auction, we can still close on the property and repay the lender for any outstanding fees. And when we do that, then that person who won the auction does not get the property. Okay, they just get their money back. All right. So I have done this before. I've sold a property when somebody had an auction scheduled. We delayed while we're doing the sale. The auction occurred. There was a winning bid. But before that 10-day period happened where the bidder got the deed, we were able to close on the property, repay the lender, and no foreclosure then showed on that owner's credit report because the foreclosure didn't actually occur. Okay, so but after that 10-day period and the deed is delivered, there's no further right of redemption that exists in New Jersey. So that's our deadline, when that 10 days after that auction occurred. Okay, so that's how it works. So let's go to the third line under foreclosure and on page 230. And we're going to highlight the successful bidder must pay cash at least 20% at the auction and the rest within 10 days until a sheriff's deed is delivered to the buyer. Now, here's a little tip. There's nothing called a sheriff's deed. Sheriff's deed does not exist. The sheriff's department just writes sheriff's deed on it. It's actually called a bargain and sale deed. Chapter 19 is where we go over the different types of deeds. So in the margin here, you may want to write, or at least I have a little note for myself. Sheriff's deed is actually a bargain and sale deed. Okay, or you could write bargain and sale deed says sheriff's deed on top of it. But it's actually a bargain and sale deed. That's the official name of the deed. A bargain and sale deed. Bargain and sale deed. It just says sheriff's deed on top of it. Okay. So next, a deed in lieu of foreclosure. In lieu means instead of in Latin. So a deed instead of foreclosure. So an alternative to foreclosure would be, well, all of these things, well, we got a couple things here that are short sales also an alternative to foreclosure, but a deed in lieu, what is that? It is when the homeowner just, instead of getting foreclosed on, they just signed the deed back over to the lender. This is also known as friendly foreclosure, because instead of going through the court system, the borrower just agrees to give the house back to the bank, saving the bank all the expense and time of having to go through the costly foreclosure process, which on average will cost the bank about $50,000 in legal fees, in time, and damage to the property, and property values possibly dropping, right? So sometimes a lender will offer to accept a deed in lieu from the borrower. Here, we won't foreclose on you if you just sign the deed back over to us. That's one way that a homeowner could avoid foreclosure. So why do a short sale if the lender will just take a deed in lieu? Well, they're not always willing to take a deed in lieu. Plus, there is still a risk for the borrower, the homeowner, because the lender will not, if you just sign a deed in lieu back over to the bank, the lender is not going to give you a satisfaction of lien. There's a possibility, now this isn't in the book, I did this research on my own. There's the possibility that if that lender gets the ownership of that property back and manages to resell that property within 90 days and experience a loss from what you owed them to what they actually sold it for, they could get a deficiency judgment from the court for that amount, and then they could chase after you for that. Now, the likelihood of that happening is slim, but it still is a possibility. Okay. So, and I tell homeowners all the time, you don't believe me, go call your bank and ask them. If you give them the deed in lieu, you just sign the deed back over to them, if they'll sign a satisfaction of lien and agree not to sue you for any deficiency judgments. I bet you they won't do it. So either way, it's still a risk. So that's a risk you're going to need to take. So when a lender contacts a homeowner and says they're willing to accept a deed in lieu, I explained to them what a deed in lieu is and what the dangers of that are still. But I also tell them, if you do nothing, you will get foreclosed on. If you give a deed in lieu back, you will not have a foreclosure on your book, but the lender can come after you for a deficiency judgment still. And if you agree to continue trying to do a short sale with me, we could continue marketing the property. We may never get an offer, or we could get an offer that's not satisfactory to the bank, or we could get an offer that is satisfactory to the bank. And then the lender won't chase after you for any deficiencies. So these are the risks. I suggest that you speak to your attorney now, have your attorney explain it to you and guide you on what you should do next. Because I have a financial interest here. There's a little conflict for me, even though I'm explaining it to you correctly, because I'm an honest guy. Don't take my word for it. Discuss it with your attorney, because I have an interest here. I do not get paid unless I sell your property. So I don't want you coming back later and saying that I misexplained it to you or something like that. You know, I want you to discuss this with your attorney and have your attorney have that discussion with them, and then let me know if you're going to do a deed in lieu or if you're going to go through with the continue trying to sell it by short sale. Okay. And often the attorney tells them just continue with the short sale thing. Probably because the attorney also makes money when they do the sale. All right. Now, deficiency judgment, I just was talking about that a little bit. What is a deficiency judgment? Well, what is a judgment? A judgment is a decree by a court where a judge says that this person owes you money, right? A deficiency judgment says that although you paid somebody back, you didn't pay them back all the money you owed them, you were deficient. So you still owe them this much money. That's all a deficiency judgment is, okay? You see how I walk through that definition? Once again, just let's analyze the words there, okay? And lastly, an REO is a bank-owned property. REO stands for real estate owned. It's real estate that's owned free and clear by the bank with no liens or other, with no liens on it. So it is free and clearly owned by the bank. Sometimes banks have their REO in their inventory, their bank-owned properties that they need to sell. All right, hopefully they'll sell them with you. So under deed in lieu of foreclosure on page 230, let's highlight the first sentence. And then in the third sentence, let's highlight major disadvantage to the lender. So we're highlighting an alternative to foreclosures for the lender to accept a deed in lieu of foreclosure from the borrower. The major disadvantages to the lender. That's what you should have highlighted. Even though I just explained to you that there is a disadvantage to the borrower, because they can always come after them for a deficiency judgment, what is the major disadvantage to the lender? Well, if the lender went through foreclosure, if there's any other liens on the property, foreclosure would have wiped them out. But because they didn't actually go through foreclosure, the borrower just signed the property back over to them. If there's any other liens on that property, liens run with the land. So the lender's accepting the ownership of that property along with those debts, those liens. And then the lender would be responsible for paying them. Okay, so that's what the major disadvantage is to the lender. Okay, on page 231 under real estate owned, on the second paragraph, we're going to highlight real estate owned REO and just right above it, bank owned property with no liens. LIENS, bank owned property with no liens. And we have concluded chapter 13. Let's do the key terms to review for chapter 13 as I work on opening chapter 14 slide. Show. All right. Key terms, there's only one key term here. Borrower. What's another? Who's the borrower?
Mortgagor.
Okay,
Mortgagor. 12 is A. Borrower's statement of how much remains on the mortgage debt.
Where is it? Where is it? Where is it?
Estoppel certificate.
That would be the estoppel certificate. 7 is B. Arrangement by which the mortgage holder gives up their priority.
Coordination agreement.
Yes, it is. 20 is C. Charging higher interest than allowed by law.
Usury.
Usury. 21 is D. A clause ensuring that after repayment, the lender has no claim on the property.
Is that a, oh no.
Defeasance clause.
Yes, very good. 5 is E. The defeasance clause. Clause stating that if the property is sold, the debt is immediately payable.
Acceleration clause.
Aviation.
Alienation clause.
Alienation clause.
Alienation.
Alienation clause. 2 is F. That's the clause that says that if the property is sold, the debt is immediately payable. You'll see when we'll get to alienation, acceleration still, but I can understand why you got that one. Pledging of property as security without surrendering possession. Upper crusty sounding word.
Hypothecation.
Hypothecation. Correct. 9 is G. 9 is G. A clause stating that if the debt, a clause stating that in case of default, the whole debt is immediately payable.
Acceleration clause.
That's acceleration.
1 is H. Now, those definitions sound a lot the same, right? What was the other one? A clause stating that if the property is sold, the debt is immediately payable. That would be the alienation clause because the alienation is the transfer of property. This one says a clause stating that in case of default. So one is in case of sale and one is in case of default. Okay, so that's wherein the differences lie. All right. So 1 is H. A court order that the borrower pay money by the lender after foreclosure.
Deficiency judgment.
Deficiency judgment, yes. 6 is I. A document given to purchaser of foreclosed property.
Reduction certificate.
When you buy a foreclosed property, what's the document that's given to you?
Classification.
When you buy a property at auction, what is the document given to you?
Sheriff's
Sheriff's
deed.
deed.
Sheriff's deed. 17 is J. Failure to live up to part of a mortgage agreement.
Default.
Default.
You are now in default. 4 is K. Another word for lender.
Mortgagee.
Mortgagee.
E. 11 is L. Lender's statement of how much remains on the debt.
Reduction certificate.
14 is M. Lender's statement that the debt has been repaid in full.
Satisfaction of mortgage.
16 is N. A personal promise to repay a loan similar to a bond.
Mortgage.
No.
Note.
Yes. Note. 13 is
note.
O. Personal promise to repay money similar to a note.
Mortgage.
Hold on a second. But let me read the last one again to you. Personal promise to repay a loan similar to a bond is a note. So personal promise to repay money similar to a note is a
Mortgage.
Bond.
bond.
Oh, bond.
Oh,
The previous one just gave you that. They just said it.
I was looking for more. I was looking for mortgage too.
I'm waiting for that one.
3 is P. 3 is P. Proceeding to auction foreclosed real estate.
Short sale.
It's a sheriff's sale. 18 is Q. To seize and sell property pledged for a debt.
Short sale.
Closure.
Foreclosure. 8 is R. Written pledge of real estate as a security for a loan.
That's more.
That's the
That's
mortgage.
the mortgage. 10 is S. Lender agrees to accept sale proceeds even if less than the debt.
Short sale.
Short sale. 19 is T. And property acquired by lenders. What do we call a bank-owned property?
REO.
15 is U, REO. Correct. Chapter 14. Chapter 14. Ready? Here we go. Financing 1, conventional FHA and VA loans. Unfortunately, the chapter 15 and 16, they talk about the same topics and they're kind of scrambled all over in a nonsensical order. So I'm going to try to explain stuff straight out, and then we're going to bounce all around highlighting it everywhere where it says it to try to simplify it as good as possible. Okay. So at the end of this chapter, you're going to be able to describe the issues concerning mortgage financing, including various payment plans, distinguish differences among conventional, insured, guaranteed loans, and New Jersey's homebuyer programs. So at the bottom of page 235, let's just highlight interests. That line, we're going to highlight that bottom line. Interest is the rent the borrower pays the lender to use their money. When you get a loan, what is interest? Well, it's the rent you pay to use someone else's money. You know, they got to get something out of it, right? Oh, home purchasers often require down payments on a loan because most people don't have all the cash that's needed to buy. Interest, that's the charge, the rent that's paid to use or borrow someone else's money. And interest is calculated on an annual basis. Now, value is a word that means 100%. Value means 100%. Okay. You want to know the value of your home? What am I asking? You know, you want to learn what the full value of it is, right? So value is a word that means 100% if you were to simplify it. These are all words that we're going to be learning. So I put all the definitions up front here, or a lot of them. LTV is the loan to value ratio. It's how much the lender will loan you in comparison to the appraised value of the property. So let me see here. So your typical conventional loan requires 20% down on conventional loans. So the LTV, the loan to value ratio, is 80%. They will loan you 80% to the appraised value. So that means the borrower needs to put down 20%, right? Now, what's the LTV on Anybody know how much money down is required on a FHA loan?
3.5%.
3.5%. So what is the, whoa, LTV? That's pretty thick. What is the LTV on an FHA loan?
96.5.
6.5.
Okay, so 96.5%. So they will loan you 96.5% of the appraised value. So this is loan to value. Each still thick. What happens when you're really zoomed in? Regular ink looks thicker than it. So that would be the loan, there we go, to value ratio. Okay. So that's the way to think about it. Anytime you hear this term LTV, it stands for loan to value ratio. And if you have an LTV of 96.5, you know how much the borrower needs to put down, right? How much they need to put down? Well, if they 100% of the value minus the amount you could get for the loan will give you 3.5%. So the borrower has to put 3.5% down. And if the LTV is, and let me see, if the LTV is 90%, how much does the borrower need to put down? 100 minus 90 equals 10%. Okay, that's how we figure it out. It's pretty easy. Do not screw it up and be thinking, well, if the borrower needs to put 10% down, then the LTV is 10. Now, remember, it's how much they will loan you in relation to the value. They're not going to loan you 10%. They're going to loan you 90. Okay. So big difference there, right? Now you need to understand this lingo. When you guys start working at real estate offices, you're going to get mortgage reps coming up to you all the time. And they're going to talk about their loan programs. They're going to be spitting out all these terms. Oh yeah, the LTV, we got a program here with an LTV of 96.5 on that one. It's actually 97%. Well, we have an LTV ratio on this one. And you're going to be like, oh, wait. I got to get my notes. Okay, so this one's actually not that hard. If you just remember loan to value, it's how much they're loaning you. They're telling you right there, the first word, how much they're giving you, how much they're loaning you. All right. So the equity, what is equity? Equity is the difference between the current value of the property and the amount owed on it. Now, equity can be built in three common ways that we have here. I mean, you can get equity in other ways. Let's just go with this. Equity is commonly done in three ways. You could pay down the debt, right? So equity is the difference between the value of the property and what's owed on it. So this hand is the value of the property and this hand is what you owe on it. So equity is usually equal to your down payment amounts when you purchase a property, right? So you purchased the property for this much, but you put $10,000 down. How much equity do you have in the house? What's that difference between what's owed on the house and what the value is? You put down $10,000 when you bought the house. Equity is equal to $10,000.
$10,000.
Now, if the property value goes up by $10,000, you gained another $10,000 in equity. So how much equity do you have now? 20,000. Let's say I do improvements to the house and the profit or the equity that's built on top of my improvement cost is another $10,000. I now have how much equity?
30.
30. You see the three ways, these are the three common ways that you can build equity in your house: through periodic payments, paying down your debt, building equity. The market values just naturally increase because market values go up and down, they're cyclical. Or you do improvements on the house, forcing an increase in the equity. All right, so what are we highlighting here? Okay, so let's highlight at the top of page 236, the amount of mortgage loan in relation to the value of a home. Write the word appraised above the word value. The appraised value. So the amount of mortgage loan in relation to the appraised value, not some crazy ridiculous price that a borrower just offered. In relation to the appraised value of the home, is the LTV, or loan to value ratio. Now, years ago, back in the 20s, when you went to buy a house, it was 40%. What does that mean? If you have an LTV of 40%, what does that mean? How much money do you have to put down, or to buy the house? Put down
60%.
You needed to have 60% of the cash to buy the house. That was a lot of dough to have. To as much as 95 or 100% today. And payment periods have also lengthened from the 20s to from 5 years in the 20s to as much as 30 or 40 years today. All right, check this out. In the 20s, you needed to have 60% of the cash to buy a house. And the amount that you borrowed, that other 40, they only gave you 5 years to pay it back. Now, I know some of you may be thinking, yeah, but how much money was a house worth in the 20s?
Thank you. Bingo. I was going to ask you that.
Well, how much money were people making in the 20s?
That's true. And the dollar had more value, I think.
And we were going through the Great Depression.
Not
the 20s, that was the Great Depression.
No, I thought the 30s were. 30s, yeah, the 30s, not the 20s. Then again, I wasn't there, so I don't mind.
Yeah, the 20s is Great Depression. We also had that's why they built the Empire State Building back then too, to try to build a lot of jobs and to raise the morale and pride in our country and stuff when everybody's depressed. And it did create a lot of jobs back then. All right, so let's see. So when rates are high, alternative forms of financing could be attractive, like the adjustable rate mortgage, which is short. We have an ARM, we call it, adjustable rate mortgage. Seller financing is also attractive when the banks are not lending. We have government programs that may allow for a higher loan to value ratio, such as the FHA and the VA. FHA insures loans. The VA are loans for veterans. They guarantee 25% of the loan amount. State programs are also available through the New Jersey Housing Mortgage and Finance Agency, or NJHMFA for short. We also have loans available through the USDA. Yes, those are the ones that inspect our food, the United States Department of Agriculture. They offer loans to farmers, but also to people who live in rural areas. You could even get 100% financing today to buy a house in a rural area through the USDA. And they offer subsidized loans with interest rates as low as 1%. All right, and there's other loan programs available as well. So let's get through this. Let's take a look at the payment plans that are available. The word amortize, it means to kill off agonizingly slow over time, right? Your loan is, most average loans are what, 30-year mortgages? So it's killing off the loan slowly over time through periodic payments that go towards the principal, the amount borrowed, and the interest. With your monthly mortgage payment first getting applied towards the interest, and then the balance applied towards the principal to pay down the debt. So what is the principal? Principal is the amount you borrow. Interest is the rent that you pay for borrowing that money, right? So in a fully amortized loan, the payment amount does not change. Your monthly mortgage payment remains constant over the life of the loan. Your first payment to the last payment, it's the same. The only thing that changes is how much of that monthly payment gets applied towards the amount you borrowed and how much gets applied towards the interest. So at the beginning of the loan, and for at least the first half of the loan, the majority of that monthly mortgage payment gets applied towards the interest owed. And then as it gets towards the end of the loan, more of your monthly mortgage payment gets applied to pay back the amount that you borrowed. Okay, so let's highlight under payment plans. Amortize means to kill off slowly over time. And then on the third line, we'll highlight regular payments are applied first to the interest owed and the balance applied to the principal amount over the term. Here, let me temporarily turn to the next. Oh, wait, no, it's not there. Yeah, here. Look at this slide for a second. This is an image that you see on the top of page 237. Each one of these lines represents a year in a 30-year mortgage. All right. Your monthly mortgage payment, each monthly mortgage payment is one line here. The dark part of the line is how much of that monthly mortgage payment goes towards the interest, and the light color part of the line is how much goes towards repaying the amount you borrowed, the principal. As you could see, for that first year, the majority of your mortgage payment goes where?
To the interest.
To paying back the interest, and a very tiny amount gets applied towards the principal. And that happens, you know, it starts to flip after about halfway through. Then it starts flipping where more of your monthly mortgage payment goes towards the principal and then less towards the interest, but that's towards the end. Why do lenders do that? How come they don't just have it even first to the last month, first year to the last year? Because
Go
ahead.
They want to collect their rent as soon as possible, their money.
Okay, why? Why don't they just apply it even all the way across?
In case default happens or they sell off the contract to a different lender.
In case of default or in case you sell the property, they want to get as much of their money up front. Plus, most people don't stay in homes for the full 30 years, at least these days. It's becoming more and more of a trend, right? As we become more of a more of a nomadic society where people are not establishing families and living in the homes for the, you know, you got to live near where you work and you're going to build your career and your pension. You need to live near the factory for the rest of your life, right? Most people, they change jobs a lot, you know, and so a lot of people work from home, or they don't have to be living by a factory or a place of employment. They could work remotely because everybody wants to be a boss or have these jobs that allow them that privileges. So what happens then? Now, you're allowed to move. You don't need to be tied down. So people tend to change their housing more often. And because of that, they tend to sell more often. Do you know how long people stay on average in their homes these days?
5 years.
10 years.
5 to 7 years on average.
Wow.
But we're also starting to see a trend now, even going down to 3. Okay, so depending on your job, I guess, would dictate that. All right, straight loan. What is a straight loan? A straight loan is an interest-only loan. So on the second bullet point, under fixed rate loans, we're going to highlight on the first line just the words interest only, and then just below it, we're going to highlight straight loan. So a straight loan is an interest-only loan. Okay, so straight loans or interest-only loans, they're used for several different things. First of all, a straight loan is you'll never pay it unless you pay it back in full, unless you make extra payments or you pay it back in full, because it's interest only. You're only paying the rent. You're never paying down the principal, the amount you borrowed. But the straight loans are usually not meant for long term. Because of that, you'll never pay it back. You're only making interest payments. So it's often used for second mortgages in the form of a bridge loan. When you need to sell one home, when you need to buy the next home before you sell your existing one, many people can't afford the mortgage payment on 2 loans at one time. So you get what's called a bridge loan to bridge the gap between the time you sell your existing home and buy the next one. This is a short-term loan, not meant for terms longer than 6 months, really. It's an interest-only loan. And so it allows you this loan would allow you to be able to make the payments on both homes, because most people can't afford to make a mortgage payment on two mortgages, right? So this temporary loan would allow you to do that. Now, most of the time, we try to coincide closings to get the closings to happen with the same day or within weeks of each other, so that, but not months, so that we could avoid the person having to make 2 mortgage payments. This is also a short-term loan that could be used for people who are investors that are fixing and flipping homes, or for builders who want to make the smallest payment possible during that building period. So they will get a straight loan for that. We also have partially amortized loans. A partially amortized loan. What does the word amortize mean? Let's analyze this partially amortized. So the word amortize means what?
Kill off slowly.
To kill off slowly. So if it's partially amortized, that means you're only partially killing it off. So by the time you make your last mortgage payment, the loan does not fully amortize, meaning that you did not fully kill it. So there's going to be a balance still at the end. So the last payment, in order to kill off that loan, is larger than the rest of them. That last payment balloons in size, so therefore it is called a balloon payment. So a partially amortized loan, the last payment is larger than the rest. What do we call it?
Balloon payment.
Balloon payment. It balloons in size. Okay. See, these are questions that you could possibly be getting on exam. Intense. All right. Trying to help a brother out here and sisters. Okay. All right. Biweekly mortgage. A lot of people misunderstand this as having to make 2 mortgage payments a month. No. A biweekly mortgage is making a half a mortgage payment every 2 weeks. The equivalent of 26 half payments a year, which adds up to 13 monthly payments a year. Wait. My math is a little fuzzy. How many months are there in a year?
12.
So 13 monthly payments gives you 1 extra payment. That 1 extra payment gets applied entirely to the principal. And by doing this, you could actually reduce the time on a 30-year fixed rate loan from down to 23 or 22 years. you're knocking about 8 years of payments off of the loan, saving you a lot of money in interest. Now, let me show you something really quick. In the Math How-To Study Guide, which is in the supplements folder in the Google Drive, let me try to, let me just open it up really quick here. Sorry. Math. Here we go. No. Math problem. It's called Math Problems. That's the Math How-To Guide I created. But the slide, I need to update it. The slideshows, I think I have better explanations in the slideshows now. I think I've updated it through the slides. But I have this Math How-To Study Guide I created for you guys that teaches you how to figure out just about every math problem that you're going to get. All right. Well, there's one here where I have comparing two loans, how much you would save on a 30-year mortgage that's at 5% interest rate for $300,000 versus a 25-year loan. Here we go. And I go through step by step how you calculate this. Look at the total savings. If you pay off a loan only 5 years sooner, how much you would save. It would be more than that if you do it through these periodic payments. This is comparing two different loans here, a 25-year loan versus a 30-year loan. But if you had a 30-year loan and you made the one extra payment, paid it off sooner, you would actually end up saving even more than this. But this is comparing two loans, and look at that. That's $53,500 in interest payments. So simply making one extra payment a year on your mortgage loan, you can knock off 8 years, saving you even more than that. Now, if you could save up one extra payment and make one extra payment each year in advance, you would save even more money, because that entire year they can't charge you interest on the money that you already paid off. A biweekly mortgage loan is a way for people who have trouble saving up that extra money to make those extra payments. So it kind of transparently does it when you automatically set up a half a payment every 2 weeks. It's taking a little bit, it's like taking a couple extra pennies to change out of your pocket and putting it to the side, you know. But a lot of times when we take the change out of our pocket and we put it to the side and we see how much we got to grab it and spend it on something, right? Because we got extra money. This is a way for you to prevent doing that. It becomes transparent to you, okay? So for people who have trouble saving that money and putting it to the side, a biweekly mortgage is an excellent option for you to be able to do this, okay? It could save a lot of money. Yes.
I just got here, my bad, but what page are we on?
We are on page 236.
All right, thanks.
So once again, here's the payment chart with the interest. Okay, so under biweekly, the last bullet point on page 236, we're going to highlight. Oh, actually, we didn't highlight anything in the third bullet point, did we?
Yeah, we highlighted the balloon payment on the third one.
Okay, well, just in case anybody didn't, I'm not sure if I told everybody to do or not. Highlight the final payment is larger amount than the others. This is called a balloon payment, and this type of loan is called a partially amortized loan. Then in the next bullet point, highlight a biweekly mortgage involves half payments every 2 weeks instead of monthly. Then go down 2 lines and highlight the extra money applied entirely towards the principal. Now we're going to go over the anatomy. So all of that was talking about fixed rate loans where your monthly mortgage payment is always the same. Now we're going to talk about adjustable rate loans, or ARMs for short. So on page 237, let's highlight the title, adjustable rate mortgage, and write ARM next to it, ARM. You know, this is usually the lingo. We usually don't talk and say the whole thing, adjustable rate mortgage. We usually just say, is that an ARM? Right? Yes, I have two of them. Okay, we're going to highlight an adjustable rate mortgage. Adjustable rate mortgages shift the risk or reward of the changing interest rates from the lender to the borrower. And now we're going to look at the anatomy of an adjustable rate mortgage. How do they work? Well, first of all, we just highlighted it shifts the risk or reward of changing interest rates from the lender to the borrower. So if the interest rates go down, the borrower ends up saving money. If the interest rates go up, the borrower ends up paying more. Okay, so it takes that burden off the lender and puts it onto the borrower. That's what they mean by shifting the risk or reward. This is often an exam question in itself. What type of loan shifts the risk or reward of changing interest rates from the lender to the borrower? An adjustable rate mortgage, the ARM. Now, what determines when sometimes people are like, don't get those loans. Those loans are trouble. The loans, you know, the interest rates are always going up or down. You know, they're always fluctuating. Wrong. That's a lie. Wrong, wrong, wrong. You don't know what you're talking about. Adjustable rate mortgages usually adjust once a year on the anniversary of the loan. They're not always going up every day, up and down every day throughout the day. They get adjusted once a year on the anniversary of the loan. That's called the adjustment period. Now, what determines if the rates go up or down? Well, they're usually tied to some sort of an index. That index is usually the 1-year US Treasury bill, but your lender could use a different index, but commonly used is the 1-year US Treasury bill. If the interest rates go up or down on that Treasury bill will dictate whether the interest rates go up or down on your loan. Now, if a lender is going to lend money, usually they don't lend their own money. They lend other people's money. And if it costs the lender 2% to lend you someone else's money, and they want to earn 2% on the loan that they're giving you, how much do they need to charge you? Simple math, guys.
4%?
4%, right? If it costs them 2% to get the product, which is the money that they're going to lend to you, and they want to make 2% off of it, the markup is the margin. So they got to charge you 4%. It's the markup. Okay. Now, another reason people tell you don't get those adjustable rate mortgages, those interest rates can shoot up on you at that one time when it adjusts in a year. Wrong. There's a cap, which a cap, like the cap on this, a cap would limit how high the rate can go up in any single adjustment period. Right? Now pretend this is a bottle of soda. It's got a cap on it, okay? If I shake it up, how high can the soda go? It's limited by the cap. The cap won't let it go up any higher, right? So just like that, the interest rate is limited on the adjustable rate mortgage each year by the predefined cap. Now, if I take the cap off, what's the maximum? What's the highest the interest rate can go up in any single year? If I were to shake this up here in my house and I open up that cap, what's going to stop it from going any higher?
Ceiling.
The ceiling. So just like the cap is the maximum that it could go up in any single adjustment period, the ceiling is the maximum that it could go up over the life of the loan. Okay, so there's a way to also try to remember those two terms, cap and ceiling. Cap limits how high it can go up in the short term. Ceiling is the maximum it could go up over the life. Okay. Hopefully that helps. And then we have the worst case scenario. People are like, oh, you never know what the interest rate could go up to. Your mortgage payment can go through the roof. Wrong, wrong. Once again, you don't know what the hell you're talking about, because when you go to get the loan, they actually have it in the mortgage documents itself. They spell out for you for your particular loan, what is the worst case scenario over the life of the loan? What's the highest the interest rate could ever go up, and what's the highest your mortgage payment would be? You actually have to sign that paper next to that figure when you're getting an adjustable rate mortgage. So people who say, or mortgage loan, so people who say that, they don't know what they're talking about, because the text is actually that large on that page. Let's take a look on a standard sheet of paper here. The text that's that large. Look at that on a piece of paper. Here, hold on a second. Here's a piece of paper and the text is this large.
Can't miss it.
It's a little bit smaller than a third of the size of the paper. So, you know, if you say you didn't see it, you're friggin' blind, because you signed right next to that too. Or you just didn't read all that paperwork. You're like, sign here, sign here, sign here. Okay, okay, okay. Okay. Whose fault is that?
Yours.
You're signing contracts. You should read the damn things. You know, I know it's a lot of paperwork to sign at the closing, but read it. Or at least have your attorney explain it. Well, what is this page? Well, what is that page? Well, what is this? What is that? At least have them explain it to you, so you don't got to sit there reading it all. All right. So, turn to page 238. On page 238, let's just highlight ceiling, sometimes called the lifetime cap, is a maximum allowable interest rate. And highlight negative amortization, when the monthly payment isn't enough to cover the interest due. So let's look at the word negative amortization. Let's look at this term. What does the word amortization mean again? To kill off slowly over time. So negative amortization, negative is the opposite, right? So if you're killing off over time and negative is the opposite, that means every month I make a mortgage payment, I actually owe more money. Well, how could that occur? How could that be? That can't be right. Yes, it can. When? Well, if the monthly mortgage payment you're making isn't even enough to cover the rent due on it. So the rent being the interest. So if your monthly mortgage payment isn't even enough to cover the interest, the shortfall in interest, the rent that you paid for the use of borrowing someone's money, that shortfall is added onto the principal that you owe. And then next month, they charge you interest on the total balance, which includes the unpaid interest, the shortfall. So you're paying, here, let me word it another way. You're paying interest on the unpaid interest. Oh, that's not a good situation, right? So the banks won't let this continue to go on for long terms, okay? But there are some loans out there that have possibility of entering into a negative amortization. And that is not good, because every month you make a payment, you owe even more money. So you have loans that are structured to be that way, or sometimes lenders allow people to choose the amount of their mortgage payment. And that could end up in a negative amortization way. Or adjustable rate mortgages sometimes have these teaser rates, where they allow you to get into an adjustable rate mortgage for a below market interest rate for a period of time. Wait, so if the Fed is offering below market rates, I'm sorry, if the lender is offering below market rates, they're offering you that money for less than what it cost them to borrow it. So usually the lender will eat that negative amortization, that loss for that period of time, because they know they'll make it up for you from you in the long term on that loan. So these are referred to as hybrid mortgages. When it's a combination of a fixed rate loan and an adjustable rate loan. So they'll give you an adjustable rate mortgage that's fixed for the first year, 3 years, 5 years, or even the first 7 years, and then it becomes adjustable. So sometimes they used to have one called the 3-2-1 ARM. There's loans that'll be fixed at a ridiculously low rate for the first year. Then it goes up the next year, but it's still a low rate, but it's a little bit higher, but it's still fixed for that year. And then the next year or two, it'll go up a little bit more, but it'll still be fixed at a higher rate, but it'll be fixed at that rate. And then after that year, it becomes adjustable. So whatever the prevailing rate is in the marketplace is what the borrower ends up paying. And if those rates have shot up, so is your mortgage payment. If they went down, well, your mortgage payment's going to go down, right? So with an adjustable rate mortgage, your payment amounts can vary. Unlike with a fixed rate loan, your payment is always the same, unless you have a balloon payment, that partially amortizing loan, right? Where the last payment would be larger than the rest. All right, so that explains that. You need to know about the term negative amortization for your exam stuff. All right, straight loan, which you also need to know for the exams. I already told you about it. We highlighted it before. A straight loan is an interest-only loan. Lower monthly payments are possible because the debt's not amortized. It's not killed off at all. You're only making payments on the rent, which is the interest owed. They could be risky, and some loans, interest only, for part of a term. Payment will then significantly increase later. So a lot of times, builders or investors that get these straight loans, you're paying interest only on them for an amount of time that's agreed upon between you and the lender. Because you figure by then you would have already finished the house and sold it and paid them back and paid off the loan. But if you didn't by a certain period of time, then they start requiring you to pay back principal as well. And the interest goes up on it. Well, you start paying a lot more money now. Or if they don't charge you interest, they start charging you penalties. And that could be costly. That's how builders' loans work. They have to tell the bank an estimated time of when the construction is going to be completed. Then they have to give an estimated time of when they figure the house will be sold by. And then if it's not sold by a certain period, then they start paying a monthly penalty to the lender, which is an increase in your payment, and which goes up and up and up until it's sold. Okay, that's their motivation to pay it back and get out of that loan. I've seen builders go out of business because of a nightmare house and loan that they got. Okay. Interest, once again, is the rent that you pay on borrowing someone else's money. So let's highlight that on page 239 at the bottom again. A charge for the use of someone else's money is called interest. And then right above it, in quotes, the rent. The rent. And the paragraph above it that says interest-only loans, right next to that, / straight loan. You know, put a slash, right? Straight loan, or AKA straight loan, otherwise known as straight loan. Interest-only loan is a straight loan. And I put a notation in the margins of my book here. For builders, flippers, and bridge loans. And examples of interest-only loans would be builders, a building loan, for flipping, fixing and flipping, and bridge loans. And then turn the page. Hope you guys got calculators close by. We're going to be doing some math.
Ready to go.
All right. So what is interest? Interest is the rent that you pay for using someone else's money. And how is interest calculated? It's calculated on an annual basis. Okay, so how do we do the annual calculation? Well, I'll give you an example here. If your monthly, if you borrowed $100,000 here, you know what? I have it all spelled out here on this slide, but I'm going to actually, I got another slide where I have the math problem written out here. Here we go, which is what you see on the top of page 240. Put a highlighted box around these 4 steps. And then right on the side of that, how interest is calculated. This is actually how interest is calculated and how to figure out how much of your monthly mortgage payment goes towards your principal too. So if you borrowed $100,000 at a 7% interest rate, and your monthly mortgage payment is $665.31 because that's what the lender told you it is. How do we calculate the interest? Well, $100,000 times 7% is $7,000 in annual interest. So how much are we paying monthly in interest for that first mortgage payment? $7,000 divided by the number of payments, 12 months, and it's $583.33. And if your monthly mortgage payment is $665.31, you subtract that interest from that monthly mortgage payment of $665.31, and only $81.97 went to pay back the loan. Ouch. And it's like that for at least the first half of that 30-year loan. Now, so how much do I owe after the first mortgage payment? What's my balance now? Well, you borrowed $100,000 minus the $81.97 to pay back the principal. And now your balance is $99,918.03.
I want to be a lender. Oh my God.
They make a lot of money. They make a lot of money. Look here. Remember I told you, let's see, go back to the math how-to study guide here. In this math guide that I put together for you where I'm comparing 2 loans, look how much, if you borrowed a $300,000 at only 5% interest rate over 30-year loan, your monthly mortgage payments are $1,611. We're just talking about the loan. We're not talking about taxes and insurance on the property. We're just talking about the loan. How much would you have paid in interest to the bank if you kept that loan and paid it off in 30 years at 5% interest? You would have paid $279,960 in interest.
30.
That's almost as much as you borrowed. So that $300,000 house ended up costing you $579,960 when you pay back the money that you borrowed and the interest.
Wow.
Yeah, most people don't think about that. They're exactly, wow. I mean, what else can you say, right? Holy expletive deletives. Right. Wow. All right, let's stop staring at that because then we're going to get depressed. Okay. But yeah, lenders are making money. That's for sure. All right. So interest is calculated on the annual basis. And this is, I'm just basically spelling out the math problem that you see before you on the page there. So an amortization schedule, if what that math problem that we just did, okay, what we just did right here, if you were to figure this out, if you had a 30-year mortgage, how many months are in 30 years? How many payments would you have made in 30 years? 30 times 12 months in a year,
60.
360 months in a 30-year mortgage. So if you did this math problem here 360 times and you put all the numbers out, we call that an amortization schedule. So the lender does that, and they figure out that amortization schedule. It's a chart that shows the balance, how many, what number payments each one is, how much of that monthly payment at any given point of time in the loan over that 360-year payment period goes towards the principal, and how much goes towards the interest, and what the remaining balance is. So there's this image that you see in the middle of the page 240. This shows you, this is the first 3 months and the last 3 months of a amortization schedule that a lender would give to the borrower. They calculate all this for you. So if you notice, the monthly mortgage payment, the first one and the last one are the same. So you know this is a fully amortizing fixed rate loan.
Rick, I'm so sorry. I missed that point about 665 because 558.
The lender just gave you that number. They told you your monthly mortgage payment is that number.
Oh.
That's your monthly mortgage payment. Why?
How did you figure out that?
Yeah, well, the lender told you that's what it is.
I know my math. I want to know.
Well, don't worry. We'll be doing math where we'll figure out how the lender figures that out. But right now we're
Okay, got it.
that the lender told you what your monthly mortgage payment is, and in this case it's 665. Okay.
Okay, got it.
So on this one, your monthly mortgage payment is 665.30. Okay. The first payment all the way through to the last payment. So by just looking at the this schedule and seeing that payment didn't change, we know this is a fully amortized fixed rate loan just by looking at that. How do we know it's also fully amortizing? Because when we look at the last payment, the balance is 0. And there was no larger payment at the end. So we know it's not a balloon payment. So we know it wasn't a partially amortized loan. Okay. Now, the only thing that changed over time is when the monthly mortgage payment is made, how much of that monthly mortgage payment gets applied towards the interest versus the principal. At the beginning, the first 3 months of that loan, the majority of that monthly mortgage payment goes towards the interest, the rent you paid on that loan. And a small amount goes towards paying back what you borrowed. But that flips towards the last few payments. Only a small amount goes towards the interest, and the majority goes towards the principal towards the end of the loan. And once again, we already spoke about why that occurs, because the lender wants to get their money up front because they know that most people probably won't stay in the house for the full 30 years. So they want to get as much as their rent up front, right? So interest, the interest payments that you make on your loan are actually tax deductible. All right. So interest is tax deductible, and it's deductible by the borrower in the year that it is paid, no matter who paid it. So if you're buying a house and you negotiate for the seller to pay points on your loan, a point is prepaid interest on the loan. In advance, who could deduct it from their taxes? You get the seller to pay the buyer's points on their loan. Well, once again, I said no matter who paid it, the borrower can deduct it from their taxes. So if you manage to negotiate the seller to pay interest on the borrower's loan when they're buying a house, okay, so great. You got the seller to pay interest on their loan, and the borrower also gets to write it off on their taxes. Double win for the borrower. Now, I said point. What is a point? Well, a point is prepaid interest on the loan. So it's tax deductible by the borrower in the year that it's paid, no matter who paid it. Each point, now here's the math of a point. How do we calculate a point? It's not based on the purchase price, it's based on the loan. Because a point is interest on the loan. You know, you got to subtract any down payment amounts that you made on the house before you could calculate, so that you could calculate what the loan amount is. If I say you're buying a house for $300,000, but the lender's requiring you to put 3.5% down, what's your loan amount on that house? $300,000 minus 3.5%, your loan is $289,500. So if your loan amount's $289,000 and you're going to pay 1 point at closing in prepaid interest times 1%, that's $2,895 in prepaid interest that you need to make on the loan. Now, why would the lender want you to pay a point on your loan in advance? Well, maybe because your debt to income ratio is out of whack, and in order for you to qualify for the loan, you need to prepay some of the interest, and then they'll be okay with still lending you the money. Or maybe you're buying at a lower interest rate. A lot of times when people get loans, they're like, is this the lowest you could go on the interest rate? Can I possibly get it down any lower? And the lender's like, well, this is the lowest that you could get it. Now, what do they mean by you can get it? No, they're not discriminating against you. When they say this is the lowest that you can get it, what determines the interest rate that the lender charges you?
Your credit.
Your risk to the lender. Now, your credit is not the only factor that plays into the risk to the lender. How much money you're putting down in relation to the value of the house. What do we call that? What do we call how much they'll loan you in relation to the value of the house?
Oh, LTV?
The LTV ratio. So depending on the LTV ratio, how much money is the borrower putting down versus the value of the home could dictate, could play into the interest rate. If you're not putting a lot of money down, or you're not putting any money down, it's a higher risk to the lender that you could possibly default and just walk away. So the higher risk, higher interest rate. If you got a poor credit score, higher interest rate, right? If you have a lot of debt in relation to the income that you make already, higher risk, higher interest rate. So it's not just a credit score. There's a lot of factors that play into that. This is why they refer to this as risk-based lending. In today's society, we do risk-based lending. So how much the lender charges you in interest is based entirely on the amount of risk you pose to them in defaulting on the loan. Okay, so they may sometimes, you want to get a lower interest rate, and the lender says, well, this is the lowest that you can get it. But there is a way that you can lower it even more. And there's actually two ways the lender will suggest to you to lower the interest rate even more. Want me to share it with you? 2 ways to lower your interest rate. Here's the first. Here's the first one. And both of them involve lowering the risk to the lender. Okay. One of them is what we see in the screen in front of us here. You could prepay some interest on the loan in advance. The more interest you prepay in advance, we could lower your interest rate that we're charging you in the long run. So if you pay 1 point in interest in advance, though, they're not lowering your interest rate by 1 point. They may lower it by like 1/8 of a point. So it's not paying back a 1-to-1 ratio there. And if you, here's the second way that they could lower your interest rate. They'll tell you if you include your property taxes and homeowners insurance in your monthly mortgage payment, we'll lower your interest rate by another 1/8 of a point. Why? Well, because if you don't pay your taxes or your insurance, isn't that risking the lender's collateral? So this is a way to reduce the risk to the lender. And then they're going to pass on a little bit of an incentive to you to do that. You do not need to include your monthly taxes or your quarterly taxes and your monthly homeowners insurance payment. You don't need to include that in your mortgage payment. You don't. You can make that separately on your own. But the lender wants to make sure that those monthly mortgage payments are being made. So they want you to include it so that they will pay the bill. You pay the monthly mortgage payment all in one payment. And based off of that, they're going to make payments to your city for the taxes and your insurance company for the homeowner's insurance. That way they can ensure these important bills are being paid. Okay, so interest is tax deductible by the borrower in the year that it's paid. What's a point?
Interest.
And how's it calculated?
The total amount of the principal.
It's based on the
borrowed amount.
The borrowed amount, the loan amount. All right. Now, when you get a loan, when you apply to get a loan and you're shopping for a house, the lender will usually give you a complimentary rate lock when you actually put the offer in on the house and then you officially apply for the loan. They'll lock in that promised interest rate, that low interest rate, hopefully that you got it at. They'll give you a complimentary rate lock for 30 to 60 days. Now, on average, how long does it take to close a house?
30 to 60 days.
It takes about 30 to 60 days, usually about 45 to 60 days to close. Okay, these days. It is possible to close in 30 days, but everybody needs to be doing what they're supposed to be doing, and everything's got to be running like clockwork, and there can't be any glitches whatsoever. It is hard to close that quick, but it's possible. So don't try to stress yourself out. Just make everything 60 days. Always schedule 60-day closings. All right. So if you go past that 60-day deadline, though, you can purchase a rate lock extension from the lender. It's going to cost a couple $100 to the borrower, though. So to extend that rate lock. So now if interest rates go up, they're still locked in at that lower rate. So you got to be careful with making sure. Our job is to make sure that the transaction's moving along swiftly and smoothly. Sometimes buyers think that we as real estate agents are just pushing them through the transaction so we could get paid our commission. You got to realize that that's a thought that's going on in their heads a lot of times. And I'm explaining to you right now so you guys are aware of that. So you would be a better agent if you were to explain to them, listen, I know that through this transaction, I may seem like I'm pushing you along through the transaction and it seems like I'm rushing you. Don't think it's because I just want to get paid my commission. I'm actually trying to save you money in the long run, because there's certain deadlines we need to meet. And if you go past, for instance, your rate lock, your lender will give you a complimentary rate lock at a lower interest rate that you manage to get. But if you go past the dates that they gave you that complimentary rate lock for, if you want to, and interest rates go up, then you'll have to pay a higher interest rate unless you buy an extension on the rate lock to keep your rate lower. But that's going to cost you several hundred, if not $1,000. Okay. So I'm just trying to save you that money by making sure everybody's doing what they're supposed to, make sure the transaction's moving along smoothly to save you that from spending that money. Okay. So please just understand that what I'm doing here, it's all in your interest. Okay. See, if I do it like that, now they understand the added value that you're passing on to them by using you, right? I mean, you know what you're doing, right? Because you're explaining it to them. But if you just do all this stuff and you never educate your client and explain to them what it is that you're doing, why you're rushing stuff along. Okay, I'm not rushing. I'm just making sure everything's moving smoothly and everybody's operating like clockwork. Everybody's doing their job. Everybody's communicating. Let's when we do inspections on the homes and we find issues, let's address them in a timely manner and move on. Okay, we got to keep things moving along. Attorney review. Did that attorney respond to the other's letter? Well, get on the phone with the other one. Hey, I didn't see you responding. We need to communicate. Okay. It seems like we're rushing the transaction all the way. No, we're actually just making sure everybody's communicating so that that transaction keeps moving smooth so we could save you money. But I tell you, 99.995% of the agents out there are not explaining this step, what we're doing, why we're rushing or seemingly rushing the transaction through. And if you did, you'll be appreciated more by your clients. So that may be something you want to add to your checklist of talking to buyers, why you may be rushing along, or it seems like you're rushing along the transaction. They may appreciate you a little more. Yeah, no guarantees, but they may if you explained it to them. Okay.
I have a quick question.
Yeah, sure.
What if you know, a buyer gets qualified or locked in at like a 6.9% rate, and after that 60-day period, say the closing didn't happen, but they qualify for a lower rate this time around? Does the lender still lock them in at that same rate, like just reuses that because it's in the lender's favor, do they collect the higher interest, or is that even a thing that may happen?
Well, if it goes past the 60 days and they already had a rate lock, if they already had that rate lock, but the rate lock expired, they could just, they're extending the rate lock so that it would not go up. That's the whole purpose of the rate lock extension.
So if it, for whatever reason, drops, like if they qualify for a better interest rate that time around, is that something that happens?
You got to check with the lender. Lenders don't like to give you the lower rate. They like to give you the amount you were qualified for.
Right.
But depending on how much time we got before we close, can we rush through a pre-qual with another, can we rush through getting all approved again with another lender?
Right. It'll take longer.
It may, but it may not, because you already have a lot of the stuff. If you could get the appraisal transferred because you bought the appraisal, that you could get it transferred from one lender to the next. And, you know, you could get some of that stuff that that took all that time to just get transferred over. You may get through the process a lot quicker. So I have done it before. I
could just see buyers now just saying, oh, like, what if I get a lower rate because I have, you know, excellent credit and my DTI isn't too high and all this stuff, then what would be like?
How much are you saving if the rate goes a little bit lower? I mean, how much lower did it really go? Yeah. Plus right now, I wouldn't worry about that. With Biden as president, our rates are not going to go down. They're going the other direction. I mean, you can see it right now, inflation. I mean, with all that borrowing and printing money, he's cranked up the speed on the printing presses, you know. Listen,
trillions and trillions.
I took trillions. Could you imagine trillions? We used to think $100 billion was a lot of money.
Yep.
Now we're talking about trillions. That's like, I mean, how many zeros are in a trillion? You know, it's a lot.
Too many.
Yeah. But that's the thing. when we start getting to figures, obscene figures like this, our minds can't even comprehend the amount of money. We're just like, it's a lot. Trillions. It might as well be a gazillion. As far as our minds are concerned, is that even a real number? Right?
Yeah.
It's unfathomable for us because we never deal with such figures. But it does have an effect on us. And I went to that appraisal, that Ottawa OTTEAU appraisal class that teaches us how to do CMAs not too long ago. And the guy gave a little bit of a market prediction there. And he told us that it's estimated that in the advanced CMA class, when we get to that, towards the end of it, he told us a little bit of a market prediction based on what they do some great analysis for Fortune 500 companies out there and such. And for a lot of groups. And he gave a little predictor that over the next year up until 2022, the interest rates and everything, they're going to keep going up and all, but we're going to see a bit of a market crash in 2022. But it's not going to be like it was previously because it's for different reasons. But he's saying the market is estimated, according to him, he said the market, he's expecting it to crash at about 14%. We're going to have about a 14% loss in values of homes in 2022. But then we're going to have a little bump up in recovery after that, that'll go up about 4%. Okay. Now, he didn't get into all the details of why he got at that number, but these guys do a lot of research and they're pretty good at their predicting. Okay. You can also look at the current market statistics for the last quarter through places like Case-Shiller reports, but those things work more regional. And regional is like the whole northeastern seaboard of the United States, perhaps, but that's not regional. Real estate is local. It's not regional. Now, for spectators and stuff like that, it may be regional, but for us in real estate, if you want to price someone's house, you can't look at the whole eastern seaboard of the United States. You need to look more local in a section of town, you know, for us. So, but these guys, I'm saying these reports that you get from these appraiser groups, or this appraisal group, pretty good, helpful for us. All right. Let's see. Okay, so we're obviously going to do some math now. We're going to get into some math and stuff, but this is how you calculate a point. Okay. You get a math problem like this, similar to this, on exams. If the purchase price is $325,000 and the buyer has to put 20% down and pay 2 points, and the buyer has to pay $5,000 in closing costs, how much money does the buyer need in order to close to purchase this house? Well, remember, a point is prepaid interest on the loan. It's tax deductible by the buyer in the year that it's paid, no matter who paid them. Now, how do you calculate a point? Each point is equal to 1% of the loan amount, not the purchase price. So we need to figure out what the loan amount is. Well, if you got to put 20% down, we need to figure out what that 20% is and then subtract it from the purchase price to get the loan amount of $260. If you got to pay 2 points, 260 times 2% is 5,200. So you add up the 20% down payment, the closing cost of 5,000 and the 2 points to get the total amount of money that you need in order to purchase. That's how you figure out this problem. Not difficult, huh?
No. Pretty straightforward.
Okay. A lot of people get it wrong on exam. Hint, hint. The key there is you need to remember to subtract that 20%, because if you forget to subtract the 20% and you calculate the points based on the purchase price, and then you and then you figure out the 20% off of the purchase price, you're going to come up with a much larger figure. And you're going to be paying interest on your own money. Because what is the point? Prepaid interest. Make sense?
Yep.
Okay. So here's a way of saying the same exact math problem. So hold on a second. Let me back up for a second so you can see that problem again. What does the question say? If the purchase price is $325,000 and the buyer has to put 20% down and pay 2 points, and the buyer has to pay $5,000 in closing costs, how much money does the buyer need to purchase? Another way of saying the same exact thing is, if a purchase price is $325,000 with an LTV of 80% and the buyer pays 2 points and $5,000 in closing costs, how much does the buyer need to purchase? See, they don't tell you about the 20% that you need to figure out. And if you don't know what the hell an LTV is, right? Look, so purchase price, it's the same problem on the previous slide. 325,000 with an LTV of 80%. What does that mean? You got to put down 20%. So you got to calculate that 20%, subtract it first, then you calculate the 2 points based off of the loan amount, and then add in that 20%, the 2 points, the 5,000 to get the answer. You see the different way they could word it?
Yeah. The LTV is the main one.
So they didn't spell it out for you. You had to deduce that yourself. All right.
What is the closing cost? Because like I thought the closing cost was just how much it costs to buy the house.
What does closing costs consist of?
So is that like
what are
home
closing
inspection?
costs? What are
Home
closing
inspection and stuff
No.
like that?
Home inspection, you pay directly to the home inspection company when you're getting the home inspection. Appraisal fee, you pay directly to the appraiser when you get the appraisal. So what are your closing costs consisting of? Well, it's prepaid. It's when you have your taxes, your homeowner's insurance included in the mortgage payment. Your closing costs, the lender is trying to build up a fund of a reserve account for those fees to be paid for the coming year. And they do so by having you pay some of that in advance to them. So that's what your closing costs basically consists of, those types of expenses, and any miscellaneous lender fees as well. But the majority of that goes towards your coming year's taxes and insurance payments.
Okay.
So if you didn't include your taxes and insurance in your mortgage payment, would your closing costs be less?
Yeah.
Considerably. But your interest rate's going to be a little higher.
All right.
All right.
Thank you.
You're welcome. All right. So, okay, here's a payment. Okay, we already went over this, but I'm going to keep that close by again because if you go to the bottom of page 241, we're going to highlight what a point is. We're going to highlight the title points, page 241. And then we're going to, on the second line, it's the words prepaid interest. Just highlight those on the second line, just the words prepaid interest. And then just below it, you're going to highlight each point is 1% of the new loan. We're going to come back. We're going to do something with this chart here in a moment, but first we're going to skip it temporarily and go to page 242 and highlight on the second line, buyer's points are interest payments. I'll say buyer's points are interest payments income tax deductible in the year they're paid. And just below that, highlight the IRS allows the buyer to deduct. To deduct them. Just getting caught up on our highlighting here. Then highlight the title rate lock. And then highlight lenders may offer the borrower the opportunity to lock in at a quoted rate. On that same line, skip a few words and highlight the lender agrees to hold the quoted rate for a certain period of time. They lock in the rate. That's what a rate lock is. And right at the end of that or above it, for an additional fee, the rate lock may be extended. Just for your own edification. For an additional fee, the rate lock may be extended. For an additional fee, the rate lock may be extended. Okay. Now, under taxes and insurance reserves, which make up your closing cost, the last line in the first paragraph, highlight principal, interest, taxes, and insurance reserves, PITI. PITI is the acronym that stands for principal, interest, taxes, and insurance. You need to know that. PITI stands for principal, interest, taxes, and insurance.
Where is this? Where are we at?
Page 242 under taxes and insurance reserves. The first paragraph, last line. Principal, interest, taxes, and insurance reserves, PITI. You're highlighting that. And the following paragraph, you're going to highlight the last sentence. A PITI loan is sometimes called a budget loan. RESPA, the Federal Real Estate Settlement Procedures Act, limits the amount of taxes and insurance reserves that a lender may require. So RESPA law limits the amount that the bank could require of a buyer to put down in the reserve account for that future expenses for the coming year's taxes and insurance payments. I have all that written here in this slide too, by the way. So what is PITI? Principal, interest, property taxes, and insurance. PITI reserves go towards the next year's payments of bills. The total monthly expense for housing plus any, so PITI is the total monthly expense for housing a borrower would pay. But keep in mind, if you're buying a condo, you also have to factor in HOA fees, those condo fees as well, into your monthly overall qualification, because that's part of your monthly expenses too. A PITI loan is also known as a budget loan. Why? Because you know what your total monthly expenses for housing are because you're including them all in one payment. So you're budgeting for that. That's why a PITI loan is also known as a budget loan. It includes all your monthly expenses for housing. And then down here, you have that little note about property, you know, that RESPA limits the amount that the lender may require of you to keep into the reserve account for those coming year's expenses. All right, we're gonna stop here before we go into all the other stuff. We're gonna do a little bit of math. So how are we gonna go about doing that? We're gonna turn back to page 241. And you have this chart on page 241, like you see on the slideshow here. I want you to write the words mortgage factor chart above the chart. Write mortgage factor chart right above the chart itself, okay? This is what this chart is referred to. On state exam, you're gonna get math problems that they'll supply a chart like this for you. And you're gonna have a math problem to do. You need to know how to read this chart. I'm gonna show you how to read this chart. This chart is what the lender uses to determine what your monthly mortgage payment's gonna be like. So for instance, if you get a 30-year mortgage loan at a 5% interest rate, you take your finger, your index finger, and put it in the column that says rate and run your finger down to where it says 5% right here. And then each column is for different types of loans. Run your finger across till you get the 30-year loan. So down to 5%, and then just run your finger across here till you get to the 30-year loan. And what's the factor? 5.37, right? Everybody
Yep.
get that?
Yeah.
Now you know how to read the chart. Wasn't that easy?
Yeah, that's-
Super.
Okay, that's all it's to it, okay? Now, so what is 5.37? For every $1,000 of loan, for every $1,000 you borrow, your monthly mortgage payment is gonna be $5.37. And that's going towards paying back your principal and interest on your loan. See, different types of loans will have different factor charts. This is for a 30-year fixed mortgage loan, fully amortized mortgage loan is this chart. Different charts may have different types of loans have different charts. Okay. So I've got the directions here, how this chart works. It's what I just explained to you. Plus, above the chart on page 241, it says how to use this chart. So it shows you right there above the chart as well, in case you forget. But we're going to use this chart now to figure out, we're going to do some math. Okay.
Mhm.
Well, let's first go over some math problems here before I have you actually working it out. Let me just show you one. So how do you calculate the monthly payment? Well, if remember the loan amount is per $1,000 borrowed times the mortgage factor equals the PI. Well, what is the PI part of PITI?
Principal and interest.
Principal and interest. So if you have a $400,000 loan, here's the question. If you have a $400,000 loan with a 30-year term at a 5% interest rate, and the factor is 5.37, well, we know it's a 5% interest rate, 30-year, gives you that factor of 5.37. If we just look back at that chart, 5%, 30-year, 5.37, right? So what do? We take the number of thousands. How many thousands are there in 400,000?
400.
400. So that's where this 400 comes from. So remember, it says 400, and you see over here, it says number of thousands borrowed. So 400 times the factor. See, on this side is the formula. The number of thousands borrowed times the factor equals the PI, the principal and interest. This is the formula right here. So 400 times 5.37, which is not a percentage, that's a dollar amount. 400 times $5.37, and your monthly mortgage payment, which is your principal and interest, that is $2,148 a month for a $400,000 loan. Keep in mind, you may have a mortgage loan and you're like, no, my house is less than that and I'm paying more than that. Well, hold on, this is just the PI. This is not including the TI. which is taxes and insurance. When you add that into it, that expense would go up. That just shows you how expensive it is to live in New Jersey. Here, if we were to say that this house was in New Jersey, so it's 2148, right? So let me pull up the whiteboard. Let me just show you really quick. If your expense, if it's 2148 is your PI. PI equals 2148. That's your taxes. I'm sorry, that's your principal and interest, right? That's your mortgage loan, principal and interest. 2148. PI 2148. Okay, if you were to add in your TI plus TI equals PITI. That's the formula right there. This is the formula for figuring this out, right? Principal and interest, taxes and insurance. PI plus TI equals your PITI. So taxes and insurance, with the average property taxes in New Jersey being $9,000 a year. And let's say the homeowner's insurance is, let's say it's $700. Add that up, you have $9,700 a year is your taxes and insurance, but that's annually. So divide that by 12. And your monthly TI payment is $808.33. So $808.33 plus the $2148. Your monthly total expense for housing, principal and interest, that's just the loan, plus property taxes and insurance would be your full monthly expense for housing, would now be
$956.
$2,956.33.
Shit, you round that off, that's damn near 3,000 a month. Well, I'm just thinking as the owner, a homeowner.
Yeah.
Wow. Okay.
So just shows you how much less house you could afford by living in a highly taxed state like New Jersey. And when you got politicians talking about raising taxes all the time and you just throw your hands up in the air, you know, that's you got to open your mouth and yell from the treetops against those politicians that are raising taxes on you all the time. Okay. All right. But this shows how politics plays a role in your property, what you could afford for a place to live. Okay. Now, taxes get raised all the time. What is your tax? What are your taxes being raised for?
Municipalities raise them up for expenses for the city. Shit.
To fund the operation of government.
Everything.
Thank you.
And to have a more secure fund.
All the salaries for everybody down at City Hall, the police, the fire, the public works department, the garbage removal, even though our politicians are getting really sneaky. Back when Governor Christie was governor, he put it in his first term. He was actually pretty good in his first term. His second term, he was a piece of crap. His first term, did you see what he did? He actually put a cap, a maximum that our politicians in your towns, in every town in New Jersey, he put a cap on the maximum that they could raise your taxes each year. He capped it out at 2%. And some politicians were they were like ignoring him. They're like, screw him. He's not my master. He's not my boss. We're going to raise it whatever the hell we want. And then he put the attorney general after them for violating the law because they can't do that. So they had to reverse all that. But now those local politicians, what do? See, this is the way that you could weed out who the crappy politicians are. Now, those local politicians in every town that raise their taxes, what are they doing? Every year, they're maxing them out, raising it 2%. Every year, they're raising it 2%, the maximum they could go. And then what are they doing to be able to raise even more money from you? Some of them, your expenses that were normally paid for with your property taxes, they're pulling them out and they're separating them and billing you separately on them now. Now you may get a garbage bill for your municipal waste pickup, right? They start separating out some services, trash pickup, they cut it back. It used to be, you know, once or twice a month. Now you get it like 3 times a year, right? The trash pickup, not the garbage, but the trash, you know, if you even have it, or some municipalities cancel it. If you want trash pickup, you got to pay for your own now. Wait a minute, isn't that what our property taxes are supposed to be covering? Yeah, but your politicians want to blow your money on other stuff. This is what happens when we don't pay attention to what they're doing and we keep reelecting the same jerks. All right, so this is why a lot of people are moving out of Jersey and New York City and all, you know, going down south, right? Property taxes, cheap. You can afford more house. This is why if you go down to Florida and you want to buy a house down there, a house that up here would be like $600,000 to $1 million, down in Florida, you're going to pay $250,000 for. The same house. Oh, but excuse me, I'm sorry. You'll probably get more land down there too.
More property tax.
And less property tax. So taxes and insurance, as you could see, we just drew, they make a big difference. Okay, so let me give you a math problem. I'm just gonna make one up right now off the fly, off the cuff, okay? I'm gonna make up a problem and give it to you. See if you guys can figure it out. You have to use this mortgage factor chart. That's on page 241. And that chart on page 240. Okay, well, let's try. Yeah, you need both of those charts. The chart on page 241, you need to figure out what your mortgage payment is. And the chart on page 240, you need to figure out how to calculate how much of that monthly mortgage payment goes towards paying down your principal. So I'm gonna write out a question for you. Let's see how we're gonna word this. I'm gonna type it in here. Let's see. Purchase price of a house is $325,000. As an LTV of 90%. You have a 30-year loan. 30-year term at 4.5%. Taxes are $9,000. Insurance is $800. This is going to be a couple part question, so I can see that you're breaking it down and getting each part right, okay? I want you to tell me first what the PI is. What is PI?
Principal and interest.
So I want to know what the monthly mortgage payment is. That's the PI. That's just for the mortgage loan. Then I want you to tell me how much of that monthly mortgage payment goes towards the principal. And then I want you to tell me what the pity is. So there we go. That's the question here for you. It's a 3-part question. Whoop. I just made that up. Okay, so that's a 3-part question right there for you. The purchase price is $325,000. The LTV is 90%. You have a 30-year term at a 4.5%. I want taxes are $9,000. Insurance is $800 a year. I want to know how much of the monthly. I want to know what the mortgage payment is, first of all. Then I want to know how much of that monthly mortgage payment goes to pay down your principal. And then I want to know what your pity is. I'm going to try to work it out on a piece of paper here myself really quick so that I could be able to answer it. And then as you guys get, when you guys get all 3, send me an instant message in the chat window of what number you got. I'm going to temporarily pause the recording. Please remind me to unpause it when we start getting the answers through. Getting it out, we're just going to resume the recording so the recording can see what what exactly it is I'm doing here. All right. Just to recap, you have to before you start here, the first step, you need to figure out what the loan amount is. If the LTV is 90%, $325,000, the purchase price times the down payment of 10%. Because if the LTV is 90%, it's 100 minus 90 is a down payment of 10%. So 10% down payment, 325 times 10% is 32,500. This is the down payment amount. Okay, so let me continue here. So the loan amount, you subtract that down payment amount from the, let me put that number here, instead of saying 10%. Subtract 32,500. I can get the loan amount of 292.5. Divide that by 1,000, and we get 292.5. Now you multiply that by the factor.
Correct. It's going to be 148, 2.9.
148, yep. 1,482 and 97.
9. Yep.
And what is that number? What is this number?
So this is PI. This is the
PI.
So that's the PI, correct. So we got part of the problem right already. So we can put that here. 1,482.
so plus 9,000 plus 800. It's 11,282.9.
Okay, so let's do this next. So then we could do this. How much of the PI goes towards the P? Well, we need to figure out what the I is and subtract the I from the PI, and we'd be left with the P, the principal, right?
Isn't it 292?
So how do we calculate interest on an annual basis? So you take the loan amount of 292,500, right? This is for calculating the interest. 292,500. What's the interest? 4.5%. That gives us an annual interest of 13,162.50. Okay, this is annual I. So divide that by 12 to get the I.
Monthly.
And that gives us 196.
I got it now. I thought the principal was the loan amount. I thought that's what you meant.
Well, it is the loan amount. It's for the monthly mortgage payment. Okay.
Right. Not that even like total. That's why I put the total amount.
Oh, the
on my
total
end.
292.5. Yeah, I want to know what
Yeah.
the monthly. Here,
Got it.
what your principal payment is. So now we take this over here, we put 1,088. So you subtract the I from the PI and you're left with the P, which is 386. And I think it's rounded up to 9 cents or something like that, 9 or 10, something like that. So 386.09. But we don't need to worry about the pennies. Let's just keep it at the dollar amount here. Right? One more step. What's the pity? Well, what is the TI?
$9,800.
Okay, so it's 9,000 in taxes, 800 in insurance. This is annual. You just add them up, you get 9,800. Divide that by 12. Because this is the annual TI. And you get 816.66. 816.66. So we already have the PI here, so I'm just going to put PI 1482.97 plus the TI. Oh, I'm running out of space here. Let me move this up a little bit. Plus the TI of 816.66, and that gives us a total. That'll give us the PITI, which is $2,299.64. And that's the pity. Right? So this is for how you calculate the interest. This is how you calculate the pity. This is how you calculate the principal. And this is the loan amounts. Well, to calculate the loan amount, you did the down payment, you have to calculate. And this is how you calculate the loan amount. A lot of little math problems, all simple math, but it's easy to get lost in it because look how many math problems we did there, even though this was a multi-part math problem. Is anybody still lost, or did you watch and see how I calculated everything and you're okay?
We're all good.
We're gonna see these multi-part problems on the exam.
No, I'm just giving it to you. You'll get a simple one-part problem. Maybe maybe the one part problem requires you first to figure out the PI. Look, here, let me take the same problem right here. Let me copy this. And I'm going to, I'll give you another one right now. So I'm going to take the same problem. Yeah, I just copied and pasted it. Let's make this a little bit, let's do this. I'm gonna remove this LTV thing because you need, that's a problem in itself. You need to know what the hell an LTV is. All right. And we could remove this stuff, taxes and insurance. I'm just gonna add, I'm gonna make this a real simple problem for you. But in order to figure this problem out, if the purchase price is $325,000, you have a 30-year term at 4.5% interest rate. How much of your first month's mortgage payment goes towards the principal? As you guys get that, you could put it in the chat window there. I'm just going to calculate it really quick here. Hang on. Hey guys, the question is not what is the PI, the question is how much of that monthly mortgage payment goes towards the principal. Let's start off here. What is the factor?
5.07.
Okay, so the factor is 5.07. Hold on, let me do this in black ink in case anybody's colorblind. Sorry. I know it's colorblind people cannot read red. So 5.07 is the factor. So what do we do? First step. How many thousands are in 325,000? Well, divide it by 1,000 and you'll get 325.
25.
So 325 times the factor of 5.07 gives you 1647.75. 1647.75. And what is this?
That's PI.
That's PI. There we go. I'm just writing it there so I don't forget and get lost in my numbers, right? Now we need to figure out what the I is, subtract that to get the P. How do we calculate interest?
325,000 by 4.5%.
All right. 325,000, the full purchase price, times the interest of 4.5%. That's 14,625. 14,625. What is this? This is the annual I. So we got to divide this by 12. And that gives us 1462.50. So we subtract that, and then we're left with
I got a different figure there. 14.
well, am I wrong in the math here? 16, it's always possible. 1647.75 minus 1462.50, 185.25.
No, hold on. 14,625 divided into 12. When I divide 14,625 into 12, I get 12,1875.
Let's see, 14,625
I think you did it by 10.
divided by 12. Oh, it is 12,1875. See, I'm human. I don't know what I typed in there, what happened. That's weird. That's 12,1875. Oh, shit.
16.
Hold on a second. 325,000 times 4.5%. That's 14,625. Then we divide that by 12. And that's 12,1875. And this is that's your I, okay? So then put that up here. 12,1875. So 1647. 1647 minus 1218. That's 429. All right. I want you guys to remember, just remember the formulas. Remember, you could use a calculator for this. You just need to remember this formula right here. Subtract. Okay, that's the formula you need to know. And how do you calculate interest? And how do you figure out the monthly mortgage payment? You got to use the factor chart. Per thousands borrowed, right? You could use a calculator on exams. You just need to study that. The formula. You know the formula, you could figure it out because you get a calculator. Okay.
All good.
Okay. Keep in mind, you only get 6 to 8 questions on your state exam on math, 4 questions about on the school exam. So there you go. All right.
And then, so for this equation, this is, so the problem that we just did, that was if someone would borrow the entire, like, for example,
Yeah,
the
yeah,
house is,
yeah.
you
I
know,
didn't. Yeah, I didn't make. I gave you what the. Here, let's word this. Let's word this a different way, because I didn't tell you that you had to put any money down here. So here, instead of saying purchase price, here, let's word it a different way. Loan amount. Okay.
Yeah.
But I didn't tell you any down payment amount required anyway, so. All right. You good?
Yep.
Yeah, man.
Everybody good?
Yep.
Okay. All right, so. Here's how we figured all this out, once again, with step-by-step instructions here on the side on the actual slideshow. Yeah, the presentation. I have several problems like this in the presentation. Show you how to calculate each step. And you could use those mortgage factor chart and that the formula for calculating interest and principal on page 240 as well. Okay. Now here's another math problem. This one they often give on state exam, probably one of the harder ones, but it's not that hard. The question is, how much, chapter 14, okay, so the question is, how much would you save on the interest over the life of a loan on a 25-year mortgage versus a 30-year? If the loan amount is $300,000 and the interest rate is 5%. Well, this is the way that you do it. I have it right here. Here's step-by-step broken down. So if the purchase price or the loan amount is $300,000 at a 5% interest rate, what is the mortgage factor on a 30-year loan at 5%? I'm sorry, a 25-year loan at 5%?
585.
And 30-year loan at 5%?
537.
5.37.
Just want to confirm I had the correct information here. You got that information from where?
The chart.
The chart, correct. So now you take the total number of payments over the life of the loan. How many payments in a 25-year loan? 25 times 12 months is 300. In a 30-year loan, 30 years times 12 months is 360. So what's the monthly mortgage payment on each one of these loans? Well, you take the number of thousands borrowed, 300, times it by the factor. That gives you $1,755 a month on a 25-year loan and $1,611 on a 30-year loan. Then you take that monthly mortgage payment and times it by the total number of payments over the life of the loan. This will give you the total principal and interest that you will pay over the life of that 25-year loan, and the total interest and principal and interest that you would pay on a 30-year loan. Now, to figure out how much interest you would have paid on that loan, just take that total PI, and instead of subtracting the I to figure out the principal, we're trying to figure out the interest. So you just subtract the amount you borrowed, the $300,000, your original loan. and it gives you 279,960 for the 30-year, 226,500 for the 25-year. Now, to compare the two, it asks you how much you would save on one versus the other. Take the interest that you paid on this one and subtract the interest that you paid on this one to get the savings. Now, there's a shortcut for this. You could have taken the total PI minus the total PI here. You would have gotten the same figure. Only you wouldn't have actually seen how much in interest you paid on this one and that one. Was that difficult? No. You just got to figure out all the payments for the two different separate loans, right? Now, this is built into the slideshow here. This is also in the Math How To Study Guide that I gave to you guys in the shared Google Drive that walks you through this. So I have this walks you through the steps right here. This is explaining each step and what is happening here in each step, okay? Are you guys getting freaked out by math or something, or is it the birds?
It's the birds.
Well, nobody's answering me, so I'm wondering what's going on here. Are you guys okay?
Yeah, I'm okay.
All right.
It's a lot to remember.
Yeah, it's a lot of little steps, but if you think about it, you know, they'll give you the factor chart, and you just need to figure out that the secret here is this step right here, the total payments over the life of the loan. That's the part that's different when working with one loan and trying to figure out the numbers versus trying to compare two, is figuring out how many total payments over the life of the loan in each one. This is the key step right here. And that's not hard because now you know the secret. All right, I'll move on. All right, so I have many math problems here at the end of this, showing you how to figure it out, right? So the monthly mortgage, principal and interest, okay? For every $1,000 borrowed, the mortgage payment will be 5.37 for a 5% interest 30-year loan term. We use the mortgage factor chart at the top of page, well, it's 241 in this book, all right, to figure that out. Another problem. Okay, so now let's go to the Your Home Loan Toolkit. Go to page 242 at the bottom. You guys are gonna be begging for the math again.
That was good. That was fun.
No, it was
Well, when we go through this, now you guys may be begging back, bring back the math. Let's see.
I always hated math.
So the Your Home Loan Toolkit at the bottom of the page here. This is a step-by-step guide on how to shop for loan costs and warns consumers about the pitfalls and charges from lenders when shopping for a loan. I have a link here to the CFPB's website. What is a CFPB? Anybody know? It's the Consumer Financial Protection Bureau. This was a new agency within the government that President Obama created. This was a big, once again, politics coming into real estate, right? This was a big controversy actually for quite a while, because President Obama created this new agency and he gave them all of these powers because he also had, you know, Democrats are also in power of Congress and the Senate and the presidency all at the same time. So they started passing all of this stuff on their, you know, without unchecked, you know, nobody can argue it. So they created this new agency called the CFPB, the Consumer Financial Protection Bureau. They gave them a boatload of money to fund their startup. And then basically the rules of this agency were, they took over a lot of the duties that HUD already had. They also became responsible for maintaining a lot of the forms that HUD had already created. And so what they did is they became in management of some of these laws too, and the enforcer of the laws. And if these laws are violated, they create the amount of fines that the violators would have to pay. And then they get to collect those funds and keep them. Wait a minute. We got an agency that was created that's allowed to create their own laws. They're allowed to create their own fines. They're the ones who investigate and collect on violations of the fines, and they're the ones that get to keep the money. Where's their best interest? Tell me that's not a monster that's just going to keep growing, because I'll create more rules and more fines. We'll investigate them and chase after people so that we could get more money and create more rules and more fines so that we could investigate them and charge people, right? All right. So the CFPB was not answerable to the President of the United States. They were not answerable to Congress. So a lot of people said, wait, if they're not answerable to nobody, they could create their own rules, their own fines, and fund themselves with them. Isn't this a fourth branch of government you just created? If they're not answerable to the president or Congress or anybody,
Yeah, they have complete control.
it's a new branch of government. So this is what the argument was between Republicans and Democrats on this. A lot of people don't pay attention to politics in any specificity. They're just like, this is my side, I support them. That's my side, I support them. But they didn't really understand what's going on here. So later on, when President Trump came in, they took this stuff to the courts. They argued it in Congress, but now we got a bipartisan Congress at the time. So now they're arguing it, and they're like, yeah, this really is going unchecked. So they didn't get rid of the agency, because that's what Trump wanted to do, is just get rid of this agency because it's redundant. It's a new agency that's doing the same thing that HUD did. They're just changing things around a lot and making things more complicated when their intended purpose was to simplify the closing process and the documents, inform consumers, give consumers more information, but also to simplify the creation of these documents and to streamline the closing process so people can close faster on their homes with more information. It had actually a reverse effect to it, because you had to supply all this additional information to the consumer. And they took a lot of laws and forms, and to streamline them, they combined them. So they made these forms more difficult to fill out. So, and with all the possible fines and penalties attached to them, lenders need to be very careful. So it ended up taking longer to close on real estate transactions now. So what we're going to need to do in this chapter now, what we're going to be learning now here, this and the next chapter about this stuff, is what were the old forms called in the real estate transaction that lenders were using, and attorneys and such, for the closing process? What were the old forms called? What were they used for? What is the new form called that replaced the old form? And there's certain timelines that they need to be given. We need to know the timelines that they need to be given in now. And some other additional things we'll need to know as well, like this term here, aliens. Okay, so let's start off with this toolkit. It's a step-by-step guide. Now, they didn't create the toolkit. There was always a type of toolkit in place that HUD created. But once again, the CFPB, to seem like they were doing something different, they just changed the name of it. They call it the Your Home Loan Toolkit, a step-by-step guide in shopping for loans. Okay. Before, it was just a guide for consumers to shop for loans. Okay, there was no name, no fancy name for it. Okay, so lenders are required to provide the toolkit to the borrower within 3 business days of their completed loan application. All right, so when is their loan application considered complete? When the aliens are present. I shit you not. Look, go to page 262 for a second. And on page 262, you're going to see something like this. Right? You see this on page 262, this section right here?
Mhm.
I want you to highlight straight down the first letter in all those words. And what does it spell? Aliens. So when the consumers provided all of this information in this list to the lender, the loan application is considered complete. And when the loan application is considered complete, then and only then can the lender begin charging fees to the borrower, other than credit check fees.
What page is that, Victor, again?
On page 262, at the top where it says intent to proceed, you see a bulleted list under that. And you see how it says aliens in bold? I want you to highlight the first letter there so that of each word going straight down that list, and it spells aliens for you, right? So what does aliens stand for? When the consumer has provided the lender with the address of the property they want to purchase, the loan amount that they're requesting, when the income for all the borrowers has been provided, when an estimate value of the property has been provided, that's through an appraisal usually, when the names of all the borrowers have been provided and their social security numbers, then they've provided aliens. The aliens are here. The aliens have landed. And now the loan application is considered to be complete. Yay. All right.
What if alien doesn't have S?
Well, then the loan application is not considered complete if all this stuff has not been provided.
So you want to say basically who is illegal in the country can buy the house?
No, because you don't need a social security number. You could use a TIN, tax ID number. And do you need to be a citizen to buy real estate? No, but you have certain rules to follow if you're not. This is to prevent foreign entities. You got to be careful about foreign entities buying real estate up in the United States. We got to worry about national security, terrorism, all kinds of other issues associated with it. We don't want them buying up real estate next to military installations or sensitive areas either. You know, we have to be aware of it. There's a lot of stuff that in real estate that's going on in the back of the scenes that gets reported to government. Government investigates that as a real estate agent, you're not even aware of. Okay. The money that's provided, where's that foreign citizen getting their money from?
I don't know, maybe he sold something in his country.
Okay, or maybe they're dealing in human trafficking or terrorist activities and they're getting that money. For this reason, anybody who's buying real estate, their money needs to be seasoned. We need to be able to trace where it came from. They call that seasoning of the funds. So those funds need to be seasoned. I'm not sure if it's 2 or 3 months. They need to have been sitting in a bank account for at least 2 or 3 months so that we could track where that money's been for at least the last 2 to 3 months. Okay, and if we can't, if say that they said, oh, well, I got the money from someone else. Okay, well, then we're going to need to see that person's bank accounts and show that the money was transferred from their bank accounts to your bank accounts. And then where did they get it from? So it gets a little bit more in depth now. There's all kinds of federal laws in place to make that, which is why now, you know, all this introduction stuff of Bitcoins and stuff like that, which, as you could see, terrorists and hackers are already using this, right? I mean, look, they shut down the pipeline here in Linden, which is the main pipeline for the refineries for the East Coast here. So the gas prices then started shooting up. There was gas shortages in the gas stations. That's because of a terrorist a hacker group held the oil companies hostage because they hacked into their computer systems and they would not release them. They basically encrypt their own data and they won't give them the key to unencrypt it to have access to their own information. They also did that with a food processing company for beef. So you're seeing the prices of meat go up. But to prevent that from happening as much, you may not be realizing it, but this was just made news like yesterday or the day before. One of the major meat distributors and manufacturers in the United States, they paid out several $1 million. I forget how many millions of dollars they paid out, tens of millions of dollars to another hacking group, terrorist group, who put a stop to the meat supply for your food. So to prevent the prices from going up through shortages and stuff for long term, the CEO paid them through Bitcoin. Okay, this is why we got to watch these new technologies of these new monetary systems. They're very dangerous for national security if they're not regulated. And right now they're untraceable. That's why terrorist organizations are using them. Okay, hacking groups, criminal organizations, terrorist groups, they're using that stuff to transfer money untraceable. It's very important to trace it. So I don't see you being able to purchase real estate using Bitcoins yet.
Yeah.
But you could see that's a whole new bag of worms we're going to open now. If you large sums of money like that are going to be able to use for purchases like this that would not be considered normal. And they can start buying a lot of real estate all over the place and then selling it and then getting the money and it's all considered normal. Isn't that another way of just laundering money?
Mm-hmm.
Yeah. Okay. That's a way of washing money. Okay. All right. So let's see. So we're going to see this in several places. Let me see. So aliens definition, we had it on 262 here. So on page 262, where it says intent to proceed, highlight the title, intent to proceed. And then highlight the third sentence that said, the fourth sentence that says, the lender may charge additional fees such as an application fee and an appraisal fee only after the consumer indicates an intent to proceed. And when did they do that? Well, when they completed the loan application. And when is an application considered complete? When the aliens are here. Right?
Yeah.
All right, I got another cross-reference for you, page 267. Okay, so certain disclosures need to be given. We're going to be learning about those disclosures. Now, when does your home loan toolkit need to be given to the borrower?
Within 3 days.
Within 3 business days of the completed loan application.
Yeah.
All right, so the CFPB came up with 2 definitions for a business day. I mean, if I were just to ask you, what's a business day? What's a business day?
What is that?
No, Sunday, Saturday, or holiday.
Monday through Friday. You don't count weekends or legal holidays, right? Well, hold on. Let's look. There's a definition on page 267 here. Two definitions exist now for business day. One definition of a business day is any day that the lender's open for business, and the other definition is any calendar day except for Sundays and federal legal holidays. Thus, depending on the lender, the creditor, Saturdays might or might not be considered. So there you go. What's a business day? Explained clear as mud.
When the banks are open.
Pretty much. So there's no universal explanation on it. It depends. It depends on the bank. It depends on the lender. Are they open for business or not? All right. Now, while we're here on this page, where it says loan estimate, I want you to write above it LE in capital letters, LE. And then write replaces the GFE. Replaces the GFE.
GFE.
Yep, just like I have here. See on the slide? Replaces the GFE. That's the good faith estimate.
Okay.
The right replaces the GFE good faith estimate. So loan estimate replaces the GFE, the good faith estimate.
Page are we on again?
Okay, we're on page 267. Were you there or no?
I was just listening. I wasn't paying attention.
Okay, so on page 267, above where it says loan estimate, you're going to write LE in capital letters. And then you're going to write after it, replaces the GFE good faith estimate. Let me know when you're done writing that.
All good.
Okay, so now highlight the second sentence. The LE must be delivered or placed in the mail no later than the third business day after the lender has received the completed loan application from the borrowers. There must be at least 7 business days between the delivery of the loan estimate and the closing. What's the matter, David? You lose your highlighter?
I did.
You want to borrow one? Not
I
so easy
did.
to do online, huh? Okay. So you're highlighting basically the last 2 sentences there on their loan estimate. Now, where it says closing disclosure, you're going to write CD in capital letters above it. And then after it, you're going to write replaces the HUD-1 RESPA. You can just write replaces the HUD-1. The CD replaces the HUD-1. And write HUD-1 like this, HUD-1. HUD-1. So the CD, the closing disclosure, replaces the HUD-1. The HUD-1 is the old RESPA settlement statement that's given to the borrowers and sellers, the buyers and sellers at closing. It accounts for every penny in the real estate transaction to give the consumer accounting of where every penny in that transaction is going. Everything from our commissions to paying off existing mortgage loans to where's every penny in that transaction going to maybe overnighting FedEx document fees that the attorneys are overnighting documents to each other. Those fees that they charge for that, it's all has to be accounted for on the HUD-1. But the HUD-1 was replaced by a new document. What's it called?
CD.
The CD, the closing disclosure, which does the same thing. They just renamed it, and they added information that needs to be on it, and they reformatted the way it looks. Now go back to page 262 for a second. 262. 2 pages back. And right here, it says the loan estimate, the LE, that replaces the what?
The GFE.
GFE. Okay. Let's go to the third paragraph under that, and we're going to highlight under TRID rule. Lenders are held to a good faith standard in disclosing fees and changes to the LE. If the borrower or the lender makes certain changes, the lender must reissue the loan estimate, triggering a new 3-day waiting period. All right.
Where's that?
The third paragraph under loan estimate on page 262. You're highlighting that whole paragraph, the third paragraph under loan estimate. It says it starts with under TRID rule. Yeah.
Okay, I see it.
Now, if you want, and only if you want to make a little note in the margin there, I made a note in the margin that says the lender eats charges over tolerance limits. So there's certain limitations that if the loan estimate is off from what the actual closing costs are at the closing table by more than a certain tolerance limit, I think it's like 10%, then the lender has to eat those losses. They need to eat those costs. They cannot charge them to the consumer. So where do you disclose the actual closing costs?
CD?
In the CD, the closing disclosure. So if the figures on the loan estimate don't match the figures on the CD, which they usually don't because they don't have all the exact numbers in yet, it's an estimate of what your closing costs are going to be at this point. This is at the beginning when you're just applying for a loan. Well, when that loan estimate comes in, if it's off by more than a certain amount from the difference of what the actual costs are on the CD, the lender has to give the borrower a 3-day additional waiting period before you could close on that loan so that they have an opportunity to decide if they want to go through it or not. And any differences in cost over a certain percentage, the lender will have to eat. So highlight, these are the changes that will trigger a new LE. And then put a highlighted box around this entire bulleted list here. And here's the slide for it right on the screen. So a new LE must be issued when the consumer requests a change in the loan amount or amount of down payment that they want to make. The appraisal on the property came in higher or lower than expected. Because, oh yeah, that never happens. There's changes in the borrower's credit score or their debts. Now, here I have a tip for you guys here, a very important tip. Buyer's agents should inform their clients not to make, you guys should do this right at the beginning of the transaction, after they get approved for a loan or pre-qualified for a loan. Tell them not to go making any large purchases or charges. Don't go buying furniture now for the house that you don't have yet. Don't go buying or leasing any new cars or making any changes in your employment, because all of these things could change the fact of whether you could still be approved to get that loan or not, because they're all going to have an effect on your debt to income ratio. And this could, even though you may have been approved for a loan, well, doing purchases like this, you may no longer, they may disqualify you. They may throw your debt to income ratio off, that you no longer qualify for that loan. And if you do not coach them, I'm telling you, it's going to happen. How would you like that? You spent all that time helping them find a home, all that struggle. You finally found them a home and they put an offer on it. You're all excited thinking you're going to close, only to find out that your lender is going to tell you later, hey dude, your clients, they no longer qualify to buy the house. You're like, what do you mean? They can't get the loan. Why not? Well, they made a large purchase and their debt to income ratio changed, so they can't afford it anymore. Right? Is that the feeling that you get then?
Yep.
Yeah.
See, De Niro in that commercial, was that Robert De Niro? Yeah, that was Robert De Niro in that movie clip I showed you before. He's getting frustrated just getting them to sign on the dotted line. We as real estate agents, after they sign on the dotted line, there's a whole bunch of stuff that got to go on still, and a whole lot of time that transaction can still fall apart. So we need to make sure that it don't. You need to coach them right, man. Because if you don't coach them right, that transaction goes south. You make no money and they got no house. So even after I coach people, sometimes they've done this. And I'm like, what did I tell you? I had a client that did that and they were like, well, the transmission went on my car. What did you want me to do? I don't know, borrow one, rent one. I don't give a shit. Just don't go buying one. You know, I told you it's going to throw your debt to income ratio off and you're not going to be able to buy the house anymore. I'm like, hey, listen, it's you, not me. You know, I'm like, do you got the money laying around that you could pay off that car? Or do you got somebody who's willing to give you the money, not lend it, but give it to you to pay off that car so that you could then buy a house? Well, my parents can lend me the money. No. They got to be able to give it to you. Because if your parents just lend you the money to pay it off, well, how's the bank going to know? Well, they're going to want whoever lends you or gives you the money to sign a document that says that they gave you the money and it does not need to be returned because it was a gift and not a loan. They're going to want you to sign a legal document, or them to sign a legal document and you to sign a legal document that says that.
What do you mean by watching you, Victor? Like physically, they're going to hire somebody to come and watch you?
What do you mean watch? No. I said they're going to need to sign off that they did not, that it's not a loan.
No, not that. You said one part. You said, well, the person is trying to buy the home or trying to get the loan says, well, how are they going to find out if I don't say anything? And you said they're going to be people watching the bank.
No. How are they going to find out?
Yeah.
Well, they see that the car was paid off. Where did the money come from? Remember, seasoning of funds and tracking funds issue?
Yeah. Okay.
You need to prove it. We're not watching you. You need to prove to them where you got the money.
Okay.
Oh, my parents gave it to me. Oh, they gave it to you? All right, well, we're going to need to see their bank statements or whatever that shows that it came from them to go to you. Okay, no problem. And we're going to need a letter from them that's notarized that says that this is a gift and not a loan and does not need to be repaid.
The lender can actually see another person, your parents' bank statements. They can do that.
Yep, or you don't get the loan. You can't get them, that's your problem.
Okay. All right.
Hey, they gave you money. They don't want to show you the bank statements?
I got you. Makes sense. I got you.
Listen, a lot of this stuff is about fighting terrorism and other issues like that, money laundering, trying to battle organized crime and all these things, human trafficking. Look, they try to launder money in all kinds of ways, or buy safe houses, or places where they could buy a house in the middle of a residential area where they could manufacture drugs, or keep or or keep people in temporarily where they're doing human trafficking or all kinds of stuff like that, you know. They
Okay.
need to, there's reasons behind why they do all this, okay? Now, the lender's responsible for that, not us. But we need to be aware of what the lender's doing, why they're doing this stuff. And we don't need to spell out it's because of terrorists and all. We just need to know that they're going to need to track the money and the seasoning of funds. That's all we need to be concerning ourselves about. We don't need to go into the whole, how does national security work? You know, we don't need to go into that. Okay.
Thank you. Got it.
You're welcome. All right. So, but this is a very important tip. I'm telling you, if you don't, this will save transactions. Okay.
Yeah.
Got a question?
Yep.
You were talking about Bitcoin before. So what if I told you, like, you asked me how much, like, how did I buy the house? And I was like, well, 10 years ago, I put this amount of money in Bitcoin and I cashed out on it. And there's no way that for you to show where the money came from, but it shows that I deposited like $400,000 in my account.
Well, then
Is
it
that
should,
valid?
well, hold on a second. How did you deposit it to your account?
Came from a wallet, a crypto wallet.
Okay. But what, money just appears in the bank account and the bank can't trace that it came from Bitcoin?
Yeah, but so what if we were running like a scheme and I gave you the money in Bitcoin? How would you know that you wouldn't be able to tell if I gave it to you or if it's legit that I actually invested the money?
Okay, so wait, you invested money in Bitcoin by buying stock in their company, right?
Yeah.
So when you sold that stock,
Or it's not a stock, it's the coin itself. Like it's different from stock.
okay, so you just bought the coin and then the coin itself went up in value, right?
Yeah.
Well, you're going to need to show when you purchased it, how much you purchased. And I'm sure you have your Bitcoin statements if you log into your account.
There's no like account. There's not like just a one service. Because many years ago, where you used to buy Bitcoin, some of those like sites and stuff aren't available. So you would put it like on a hard drive, like on a wallet hard drive, and there would be no trace of you buying that until now you cash it out like on a website or
Then you can't use
service.
that.
So it's not valid.
If it's old before there was any kind of tracing and it was only just some kind of a wallet like that, and there's no way to prove that you purchased it from them. I mean, there's got to be a way to prove that you purchased it from them. You gave them money, you bought it, and then show it when you sold it. If you're not, if you're unable to do it, then you can't use that, obviously. It's your problem. You see,
that sounds underhanded. I understand.
well, wait. How is that underhanded? Who says that?
You know, like
hold on
you
a second. Hold on a second. Who says that Bitcoin is worth anything?
We put value on it like we put value on money.
No,
Money doesn't have value.
Who says that it has any value?
We do, because there's a supply.
As
Yeah,
long as people believe that it has value, it will have value. It's the same thing as the American dollar. As long as you believe that it's worth $1, it's worth it. Look, how much is this worth?
$1.
Well, then it's worth $1 because you think it's worth $1. It says on here, this is legal tender for all debts, public and private, you know, and it's, there you go. So it's worth $1. You know, money used to be backed by something called gold or silver or some kind of precious metal, okay? Right now, it's only backed by your belief that it's worth that, the trust, as long as people believe that it's worth what it says on the face of that bill. Go to a country, go to like Uganda. How many dollars there does it take of their money does it take to buy a pack of gum? You'll see a guy there with a wheelbarrow full of billions of dollars to buy a stick of gum. Because their money's worthless. They devalued it so badly. All right. Now, same thing with Bitcoin. Bitcoin is a proposed new monetary system. Now, Bitcoin is only one of many digital currencies. All right, but digital currencies have not been accepted officially anywhere. They're not really regulated anywhere. I could create my own type of digital currency if I wanted to right now. You got Bitcoin, you got Dogecoin, you got all those other ones out there too, right? They, I mean, Dogecoin and the other one, what's that other one? They were created as a goof. But then a bunch of people who are like, oh, digital currency, got to get in on it. They actually started investing in it. Now it's got value because of all those people who believe in it.
Bitcoin actually does something. Like a lot of these Bitcoins, like Dogecoin isn't really, it's like a meme token. But they
Bitcoin,
solve
hold on a
problems
second.
in the world.
Bitcoin just been around longer. Bitcoin is basically the same thing. These Dogecoin and all that, they actually were created. Their creators will tell you they created it as a goof to show you how Bitcoin's really not backed or worth anything. It's a big gamble. If the United States government tomorrow decides that they're going to come out with their own digital currency, and that digital currency will be the official standard, it's backed by the US government and commodities in some other way, guess what happens to Bitcoin?
It drops.
Worth nothing anymore. It's going to be worth nothing. Right now, you're just taking a big gamble on it. Now, I doubt that Bitcoin's going to go away. It's probably going to stay around. Those other ones, I don't know about too much. But this is why Bitcoin is hoping that some lawsuits come in by regulators, because that will legitimize it as a currency if regulators step in to regulate it. Okay, so this is all new territory still. They're still in their infancy. Okay, but either way, if you can't trace it and you can't base a value on that, you can't show that you paid this much and now you got this much out of it. If you can't prove it, that's like me saying, well, I bought my car for $1,000 and I did all this work on it and I sold it for $1 million. Well, I can't show you the money or where the person gave it to me from, because they didn't give it a check. They just gave me the cash, and I can't show you that they gave it to me, and I can't prove it in any way. Are you going to believe that I got $1 million for my car?
No.
Nope.
Well, the bank's not going to either. And even if I got $1 million laying around, you're going to be like, yeah, I doubt you got it from that car. You know what I'm saying? So they need to prove it. They need to trace it. I'm not trying to argue with anybody. This is what the bank is. They want to be able to trace everything. Everything has to be verifiable and traceable. If it isn't, I know you, this is valuable. I've been doing it for this long, all that. I understand, but the bank don't care. Okay. Neither does the government. They need to be able to trace those funds. Okay.
That's one of,
unfortunately for you. Okay. But if you keep that money now in the bank for at least 2 or 3 months, well, guess what? Now that money is seasoned and now you could use it to buy a house. Feel better? Or not?
Yeah.
Okay, whatever. I'm just trying to explain it to you guys. Don't shoot the messenger. Come on, man. Feel attention in here. Okay, so let's
make it crypto. Call it Bitcoin.
I'm gonna agree. We're gonna call it Bitcoin.
Mm-hmm.
Bitcoin. Put my picture on there. Bitcoin, right?
Yeah, there you go.
All right. I think it'll take off.
To the moon.
I heard that El Salvador, they recently made Bitcoin.
Yeah, they did. They were the first country ever to do that. Yeah. I don't know how well that's going to work for their. I don't know if that's going to really do good for their country.
How many people in their country have access to the internet?
I don't know.
Yeah.
Not as much as we do, for sure.
The country with massive corruption already. All right. Anyway, guys, let's continue on. We got a lot to do here. So lenders could not document the borrower's pay. Okay, look, if a lender can't document the borrower's pay, and you can't document Bitcoin, you think that the bank is going to care? Look, they won't accept cash, American currency, from people if they can't document where it came from.
Mm-hmm.
So That includes overtime. People get paid overtime, bonuses, tips, and other income. So bartenders, self-employed people, strippers, okay, they have a difficult time documenting their funds. So these types of things would require a reissuance of a loan estimate because they would have to get additional documentation or something to be able to prove where that came from tips and other income, okay? The cost change for the services the borrower could not shop for. Well, then a new loan estimate will be reissued and triggering another 3-day waiting period. The interest rate changed because the borrower did not opt for the rate lock or the rate lock expired. That would require a reissuing of the loan estimate and another 3-day waiting period too. A prepayment penalty was added. Even though we're studying for exams, no prepayment penalties allowed in New Jersey, okay? The loan product was changed. The buyer decided they wanted to get a different loan, they use a different loan. Well, guess what? New LE. The APR, that's the annual percentage rate, increased beyond allowable tolerances. Well, that would be 1/8% for fixed rate loans or 1/4% for adjustable rate mortgages. All right. Turn to page 260, back to page 267. And these are the changes that would not cause the reissuing of a new loan estimate. Unexpected discoveries during the final walkthrough or necessary adjustment changes at closing, which we always have a few last minute bills that need to be adjusted, the commissions, proration of taxes, utilities, and other payments. Here, one example, let's say the house was heated by heating oil, okay? And the seller filled the heating oil tank before the summer came around. All right, before that closing can occur, that buyer put a lot of money in buying heating oil. If you're the buyer, if you're the seller's agent, you should get an oil company to come out. They put a dipstick in the oil tank. They will measure how many gallons of oil are in that tank, and the buyer is going to have to pay them for that. So those are last minute prorations, okay, that they're talking about, things like that. That would not require the reissuance of a new loan estimate. Okay. All right, let me see, where else do we have stuff written about the CDLE stuff to highlight? That was page 267, 262. Okay, 262 to 267. In between, was there anything? Okay, now we got that. Okay, 261. Go to page 261. Between 261 and 267, and then on page 253 to 254. Okay, go to page 261. RESPA, the Real Estate Settlement Procedures Act. We're going to highlight everything under Real Estate Settlement Procedures Act on page 261. The Federal Real Estate Settlement Procedures Act, RESPA, was created to ensure the buyers and sellers in residential real estate transactions involving new first mortgage loans have knowledge of all settlement costs. Now, this only applies to residential real estate transactions. It does not apply to cash transactions, commercial loans, mobile homes, reverse mortgages, and HELOCs. That's home equity lines of credit. Okay. Okay, so we're going to be looking between pages 261 and 353, and then we're going to go to 353 and 354 in a moment. Okay. But before we do, TILA, RESPA. So RESPA is one law. What is the RESPA settlement statement? now called the closing disclosure used for? Formerly called the HUD 1. It ensures parties and transactions have knowledge of all the settlement costs for every penny in the real estate transaction. They know where their money's going. Okay, every penny has to be accounted for. All right, TRID. You know what TRID stands for? The reason I drink. No. TRID is the Consumer Financial Protection Bureau integrated the Real Estate Settlement Procedures Act and the Truth in Lending Act, TILA documents, into a new disclosure called the TILA RESPA Integrated Disclosure, or for short, TRID. So the lender is responsible for the timely delivery of documents to the consumer, and they may be liable if their costs exceed certain tolerance limitations that TRID establishes. The differences between the LE and the CD. So remember, I told you the LE is the loan estimate. At the time that you apply for a loan, the lender has to estimate what your cost. Me? Talking to me?
Oh, sorry.
Okay. So the LE, the loan estimate, is an estimate of what the loan costs are going to be, what the estimated closing costs are going to be at the time you're only applying for the loan. And then you get the actual closing cost in the CD, closing disclosure, at closing or 3 days before closing. And so the differences between what was estimated to you at the beginning of the transaction and what the actual costs are, they can't exceed those tolerance limitations. So here's more information about TRID, where NAR rants about it a little bit too. Listen, the Real Estate Commission in New Jersey rants about it. You know, this isn't just a Republican Democrat thing. Everybody's ranting about the stupid things that the CFPB is doing. But now we're stuck with it. It's been around for several years now, and we're dealing with it, okay? So TRID is the TILA RESPA Integrated Disclosure Statement, making sure that consumers get disclosures given to them in a timely basis, and they have to be aware of all closing costs and a lot of different other disclosures. Otherwise, the lender could get fined and be held responsible for the differences in costs. So under TILA RESPA Integrated Disclosure, TRID, on page 261, just above the bullet points, we're going to highlight TRID rules do not apply to the following transactions. I had it written down somewhere here. Hold on a second. Okay. So TRID rules do not apply to the following transactions. HELOC, home equity lines of credit. I put a highlighted box around the bullet points there. Home equity lines of credit, mortgages secured by mobile homes or other movable dwellings that are not permanently attached to real estate, reverse mortgages, cash transactions, and commercial loans. They go on to say, well, then how do they figure out all the monies and exchanges for the for these other transactions? Well, they still use the old HUD 1 forms that were easier to fill out. All right. Okay, we already have 262 filled out, 267's filled out. Go to page 353. 353, page 353. And let me know when you're at page 353, please.
I'm there.
Hold on a second, just gotta try to find the slide because I want to do some editing. Okay, so I just made a little adjustment there. Okay, so on page 353, everybody's there? Under RESPA requirements, we're going to highlight the Federal Real Estate Settlement Procedures Act, RESPA, formerly administered by HUD, is now administered by the Consumer Financial Protection Bureau, the CFPB. It was created to ensure the buyer and seller in residential real estate transactions have knowledge of all the settlement costs. Now, RESPA regulations here, they only apply to purchases financed by federally related mortgage loans. And what is a federally related mortgage loan? Those that are made by lenders or banks whose depositors' money is insured by the FDIC or FSLIC. It's insured by the FHA or guaranteed by the VA. Made by the REC-D, the former Farmer Home Loan Administration, administered by HUD, or intended to be sold by the lender to Fannie Mae, Ginnie Mae, or Freddie Mac. Highlight RESPA regulations apply only to transactions involving new first mortgage loans. What does that mean? It doesn't apply to refinancing. Then, in the first bullet point here, on the bottom of the page here, the last three bullet points, first three bullet points of the last three in the page here, highlight RESPA Section 8. RESPA Section 8 prohibits against kickbacks. It just says Section 8 prohibits against kickbacks. Just write RESPA above it, but RESPA Section 8. This is not the Section 8 from lending, from renting. This is lenders RESPA Section 8 of the RESPA law. Prohibits kickbacks, which are illegal, unearned fees and payments to anyone who did not take an active role in working in the real estate transaction. Now, I have this corresponding information on the slide in front of you too, on the screen. Okay. RESPA Section 9 prohibits lenders and sellers from requiring that borrowers use a particular title company. They can use any title company they want. And I did not say Section 9 here on the slide. For some reason, it's not written there. So 9, yeah. And then highlight RESPA Section 10. Lenders are not required to maintain escrow accounts to fund property taxes and insurance. They're not, because you're not required to include those payments in your mortgage payment, although the lender tries to get you to. And then highlight the last line in that same section. At least once a year, lenders must return overages of $50 or more. Now let me read that whole slide there. So Section 10 of RESPA requires lenders to limit the amounts kept in the escrow account for taxes and insurance purposes. And they must return any excess over the allowable limits of $50 or more to the borrower at least once a year. They have to provide that accounting. This is why sometimes you may get your lender that sends you a check saying that you have too much money in your escrow account for your loan. And then later on in the year, they're gonna be like, oh, you don't have enough in the account. So their accounting is always bouncing back and forth. You gotta put more money in, you gotta take more, or they refund money to you. Turn the page, 354. So TILA, let's see. The TRID rule does not apply to, we already highlighted this somewhere else. Home equity lines of credit, mobile homes, reverse mortgages, cash transactions. See, I told you this stuff is repetitive and it's spread all over the book. With this newer version of the book, they tried including all this information and it's just bumbled all over the place. Hopefully the next version will be a little bit more neatly organized. After the first set of bullet points, the second paragraph, I want you to highlight under TRID rules, the lender is required to provide the 5-page CD closing disclosure at least 3 business days before closing, with a minimum of 7 business days between the issuance of the LE and the closing. And I believe that's the last thing, yep, pertaining to this TRID RESPA crap that we need to be highlighting. It's all over the book. Just study the slideshow. It's pretty much in one place, in just a couple of slides. So as you guys can see, your home loan toolkit, okay, we went over that. When does that need to be given? Within 3 days of aliens. What is aliens?
Address of property, loan amount, income.
Oh, you don't need to memorize all that, but let me ask, what does aliens mean? When they provided all the information from aliens?
They have all the required information for the loan application.
So a loan application is considered complete when aliens, all the information from aliens has been provided, right? Okay. And so here's a copy of the Your Home Loan Toolkit. And I also provided for you another guide that the New Jersey Real Estate Commission created to help buyers. It talks about the home buying process from start to end. It's not bad information for you guys to put on your own websites and to provide to consumers as well. Here's this guide that the New Jersey Real Estate Commission created for people. It teaches you the stuff from everything from shopping from a loan, but also about the home inspections. It teaches you A to Z of the home buying process. How about your credit? See, just look at the topics here. I'm not going to go over the whole pamphlet, but let's just look through this. Going shopping for a mortgage, choosing a real estate professional, finding your dream home, putting it in writing, home inspections, title search, more, financing, review, home insurance. It goes over all the details of the real estate buying process, okay? So it may not be a bad read for you guys too. Here, I'm gonna take this, even though it's on the slideshow, I'm gonna put it in the chat window for you guys so everybody gets it, okay? You don't gotta go hunting around for it. There you go. All right.
And is this in the class links?
It is in the class links and it's also in the slideshow. All these links that are in the slideshow, you could also find them in the class links Word document, the home buyer's guide and the CFPB. So they'll probably be together as well over there. Okay, and so I got a link to the CFPB's website, to the toolkit, and to the home buyer's guide that the real estate commission put together as well. All right. Here's the guidance for you that, once again, this is the note I put in here for you. You should advise people, don't change their jobs, especially if it's to a different career. Don't make any large purchases, leasing or buying cars, furniture, credit cards, etc. And try not to change your credit availability. Sometimes people think they're doing themselves right by fine-tuning their credit. Don't do that. Don't mess with your credit last minute, because you don't know how it's going to change it. Most people usually don't. They think that they're going to get rid of the credit cards that they haven't used in a while, and they think that's a good thing. It's bad, because you may be getting rid of a credit card that you had as a long line of credit. Part of your credit score is established by your stability, being at the same job for a long time. You know, if you change jobs often, that affects your credit score. You know, how much of your available credit that you use affects your credit score. Some people think having more credit available to them is a good thing. It's not. The more credit you have available to you, the credit scoring agencies look at it as a possibility that you could use it all. And that's a bad thing. All right. So that's always that possibility there that you could use it all. It's good to use your credit, but you shouldn't use more than, I think it's maximum is like 30% of your available credit to you. If you want, and then pay off your debts at the end of every month. It's a good way to, don't carry balances. It's a good way to get your financial house in order. You know, it improves your credit score, which you guys know your credit scores.
Yeah.
Now, even though this isn't a hard line credit score inquiry, you guys should get an app like Credit Karma. It only checks 2 credit reporting agencies, and even though it's not a hard credit check, it's a good way to check in on it regularly. You know, look at that. I got a pretty nice credit score. I'll share it with you.
Strong.
It's all right. It's actually kind of low right now for me. I've been last couple of years, I've been keeping it high. I've been keeping it about 840. You know, it dips about 30, 40 points every time I have charges on there, like I do book purchases or things like that. And I add a lot more debt to the credit accounts that are available. So when I have that debt balance on there, it dips my credit score, but when I pay it off, it pops back up, you know? So yeah, I could actually see my credit score bouncing around because of that. Plus I just recently bought a motorcycle, you know, spent a lot of money on buying a Harley, you know, and then all the add-ons for it. So I got a lot of additional expenses there that I need to pay off, but I got a lot of charges right now on my credit card. So I got to start working on paying that down. All right. Plus I got a friggin' $70,000 truck balance. So that's not good either. Okay, let's see. Back to page 243. And your home guidelines, toolkit, this LE, the CD, all right? So the loan estimate replaces the good faith estimate, just to recap here. What is the loan estimate? It gives an estimate of what the anticipated loan cost would be for you on a house of a certain purchase price, right? What document does the LE replace? The GFE. And does the LE need to be given to the consumer within 3 business days of their completed loan application? Aliens. What else needs to be given to the consumer within 3 business days of their completed loan application?
The
toolkit.
Oh, yeah. I was going to say a CD. That ain't it.
The toolkit, which is the booklet that explains to consumers how to shop for loans. Okay. Check this out. the law requires that the toolkit be given to consumers by the lender. Otherwise, the lender could get fined. But nobody's required to actually go over it and explain it with the consumer.
You just gotta take their word for it that they understand it.
Well, this just shows you the CFPB. I mean, they're creating stuff just so that they could look for ways to fine lenders so that they could collect money to feed themselves, you know, to build themselves up, you know. Now, I suggest it, you know, it's not a bad thing for you guys to go over it yourselves now so you can learn a little more about it, being new to the industry. And then this way you could go over this. I mean, the things that are in the toolkit, I usually gone over with people anyway on how to shop for a loan. Because if they just go to a lender is going to give them advice that's usually bad. They're going to say, yeah, you really don't want to go shopping around for a loan after, you know, I ran your credit score. I looked for it. I approved you. You know, you really should stay with us. You shouldn't go shopping around for loans now, because all those inquiries are going to negatively impact your credit score. And then you may not be able to get a qualify for a loan anymore, which that's just plain out flat falsehood. A lot of credit inquiries will affect your credit score slightly. I mean, if you're doing a few credit scores here and there, just to shop a couple lenders, the credit bureaus, they realize you're shopping for a loan, you know, so it's going to have an effect on your credit score, maybe a point or two. But that's not a big deal. That's not going to make or break you. And if it is, maybe you should not be shopping for a home right now. Maybe you should be working on getting your credit in order before you try buying a house. You know, get a better credit score. Maybe you get a better interest rate. You know, because if 1 or 2 points on your credit score is going to make or break you, I'll advise you, don't buy a home. Don't buy a home yet. You're not ready. Okay. Lenders will tell you that because they just don't want you going anywhere else. They want you to stay with them, to give them the business. So the Your Home Loan Toolkit, that'll go over some of that stuff with them, show them the difference in buying points. Should I pay for points to get a lower interest rate or not? No, never pay for points. It never makes sense to pay for points. Paying points to lower your interest rate on your loan, you're probably not going to be in the house long enough to realize any savings or value. You could actually realize a lot more savings and value instead of paying the points by using that money to put down so that you could borrow less, that they could charge you interest on. What a novel idea. Borrow less, right? That actually will save you more in the long run. All right, now the CD is the closing disclosure. That's the actual closing cost, the finalized numbers. And the CD must be given to the consumer with at least 3 days before the closing. So when does the LE need to be given to the borrower? At least 3 days after their loan application. But there has to be at least 7 days before the closing. That LE has to be given at least 7 days before the closing. Now you may be thinking, well, it'll be given to them way before that, right? Well, not necessarily, because under certain instances, remember, the LE may have to be reissued. And then it triggers an additional 3-day waiting period, plus the 7 days between the closing and the issuance of the LE. There you go, 10 days now. Right? You see how these new rules are actually making it take longer to close, how they could cause more delays in the closing? All right. RESPA, LE, I'm just hammering over this stuff over and over again for the next couple slides, also explaining RESPA to you. Same stuff. When is a new LE required to be reissued? We went over that. Changes that would not require the reissuing of a new LE. The term aliens, LE, Your Home Loan Toolkit. When does the CD have to be given? All right, all this stuff. I put all these slides in here because we go over them here. And this is all stuff now when we get to the next chapter. We're actually going over chapter 14 and 15 now in part at the same time. You need to know this for exam. What is RESPA settlement statement used for? What is the RESPA settlement statement formerly called? The HUD-1. Now it's the CD. It's to ensure the buyer and seller in residential transactions have knowledge of all settlement costs. It's required for any federally related loan, not for refinancing or any of these other. Not required for these loans. You need to know what RESPA Section 8 is. It prevents kickbacks. And RESPA Section 10 requires accounting and return of excess of $50 or more. All right, now we're here. Okay, so conventional insured and guaranteed loans. Conventional loans are those directly between the lender and the borrower with no third-party involvement or influence from outside sources. My explanation here is a lot better than the books, okay? They just give you conventional loans are those arranged entirely between the borrower and lender. Yes, with no third-party influence from outside sources. What does that mean? The transaction's entirely between the borrower and the local lender. The local lender is lending their own money. So there's no third parties lending guidelines that they need to follow. They make the final decision whether they're going to give you that money or not. And because of that, they could be more flexible in lending it to you. Now, that doesn't mean that those lenders that give conventional loans are going to be giving loans. You don't take people with bad credit to them and a poor history of repaying their loans. They're not going to get it from them. You take people like one of my friends who has like an 850 credit score and had trouble. 850 credit score. He's a fireman. He owns like 15 houses and never late on a mortgage payment. And he can't get a loan to buy a $200,000 two-family house. Why is that? Because he's cheap. He has a lot of write-offs on his taxes. He goes to Home Depot, he picks up a receipt off the ground and he writes it off on his taxes. So now come tax time, you know, if you want to get a loan, you know, you're looking at his tax records. According to his tax records, the guy's like spending every penny that he makes. So now it's hard for you to get a loan when you have too many write-offs. See, that's the downfall of not paying taxes. If you have too many write-offs so that you don't have to pay taxes, that's the whole purpose of trying to get all your write-offs there. The problem with that is when you try getting a loan, you're going to have trouble getting a loan because according to your taxes, it looks like you're spending all the money that you're making. And how are you going to be able to afford to make another mortgage, to make a mortgage payment, right? So I took him to a what we call a portfolio lender, one that gives conventional loans. These are lenders who lend their own money and they're more flexible in the decision making. So they look at the guy's tax returns and it shows he's got a lot of write-offs there. The guy's got 15 properties, never late on a single mortgage payment, 850 credit score. The guy's fireman, makes a decent buck. He owns a bar, cash business, so they know the guy got banked. And they're like, nah, we see this guy as a worthy recipient of a $200,000 loan for a two-family house that's probably going to pay for the mortgage itself. So they lent the money. But the problem is all other lenders that you take them to, they usually lend other people's money. They don't plan on holding onto the loans for a long period. So they have to look how other lenders in the secondary market, these investors that are going to buy those loans from them, because remember, your local lender writes a loan with the intention of selling it to an investor. That investor tells those banks, Here are the guidelines of the types of loans that we're willing to buy from the types of borrowers we're willing to buy them from. So when you go to your local bank to get a loan and they say, oh, you don't meet the lending guidelines for this, what lending guidelines are they talking about? They're talking about some investor who's willing to purchase that loan. If the borrower meets these guidelines and the property that they're buying meets these guidelines, they're willing to buy it. So the local bank doesn't want to lend their depositors money to you unless they know they could resell that loan and get the money back so that they can lend it to someone else again. That's how banking works. It's a little bit oversimplified. Technically, it's not correct, but for our purposes, yes, it is. Okay. That's basically in a nutshell how banking works. And when we talk about third parties lending guidelines, that's what we're talking about. But the conventional lender doesn't have to worry about that for conventional loan. These portfolio lenders, they're lending their own money. They don't have an intention of reselling them. So there's no involvement or influence from those outside third-party sources that are interested in buying their loans. They make the final decision. So you guys understand what I'm talking about when we talk about no third-party involvement or influence?
Yeah.
Okay.
Mm-hmm.
Now, there's also loans that are available from the government. Now, technically, they're not available from the government. They're government-backed loans. The government does not lend money. The FHA, the Federal Housing Administration, they don't lend money. They insure loans. If you go to your local bank to get a loan, an FHA loan to buy a house, your local lender is lending the money to you. Now, why does somebody get an FHA loan? Well, these are loans that require low down payment. And your credit score doesn't have to be as high as normally it has to be for like a conventional loan. So the FHA, the Federal Housing Administration, will tell your local bank, here are the lending guidelines, criteria for the type of houses and the price range of them, and the buyer and the criteria of the buyer. If the buyer's criteria, their financial situation, and the property that they're buying meet our lending guidelines, lend them your money. And in the event that they default on the loan, we will insure that loan so that you don't lose a penny. So the FHA does not lend money. The local bank lends the money, and the FHA insures that loan in case of default. That's why when we had the big mortgage meltdown, remember all the banks too big to fail? Well, the FHA insured a lot of loans out there that were FHA. Half the loans out there were FHA loans, and those loans defaulted. When those loans are defaulting, didn't the FHA insure those lenders and tell them they wouldn't lose a penny? So when the FHA insurance fund ran low or ran out, we had to have government bailouts. So President Bush created a bailout, or the first round of bailouts for these lenders. And then that ended up not being enough. So then President Obama came in and he did another bailout, this time a bigger one. But you had people yelling, don't do these bailouts again. The first round showed you there's a lot of waste, fraud, and abuse. Just wait a day or two so that we could put some rules in place of how that money can be used. And they're like, oh, no, we need to get it out there now. The sky is falling. We know there's going to be waste, fraud, and abuse, but it'll trickle down through the economy and everybody will get, the money will do good for our economy. Okay. And then what happened? Golden parachutes for CEOs of banks. You guys remember statements like that? Golden parachutes? Mm-hmm. These basically bank CEOs, they get paid bonuses by the amount of money that's in their bank account, not whether it came from doing business or not. And because Congress didn't put a rule in place that said it can't be used for CEO bonuses and things like that, guess what? They used it for CEO bonuses and stuff. And you know who some of the first recipients were? People like Congresswoman Maxine Waters' husband, who was the CEO of a bank called SunTrust. He was the recipient of one of those first golden parachutes. You think Congress doesn't put rules in place for a reason? Why do you think these people who they have a salary of $100,000 or $150,000 a year are millionaires and they got rich in Congress serving the people? It's ridiculous. All right, enough about that. The VA is the Department of Veterans Affairs. They give loans to veterans. They do not lend money directly. You go to your local bank to get a loan. And these loans do not require the veteran to put any money down. Why not? Because the VA guarantees that bank that in the event the veteran defaults, they will pay them 25% of the money. So it's as if the borrower put down 25% of the cash when they bought it. So they're not required to put down any more. Although the veteran does have to pay an application fee to the VA. So they call it a funding fee. Now, neither the FHA or the VA lends money. Both of them, however, any contract for purchasing real estate where the financing is coming from the FHA or VA programs has to have a special amendatory clause added to the purchase contract. You guys recall what it says? It says if the property appraises below the purchase price, the buyer can get out of the contract without penalty. We went over that in chapter 11. You need to know that for exam. It will absolutely be there. You also need to know that the VA guarantees 25% of the loan and that the FHA insures loans, but neither one of them lends money. And then we have this is government, NJHMFA, that's the New Jersey Housing Mortgage Finance Agency. They give low interest loans to people with less than perfect credit in urban target areas. Okay, now they have all different kinds of loan programs available. They got programs for first-time home buyers, for police and fire and teachers. They've got programs for people who work from home. They've got programs for people who are willing to go to work in off-peak hours where their employer would allow them to do that so that they could try to relieve congestion on the busy New Jersey roads. They have all kinds of special loan programs like that. They also have the NJHMFA. They were also that agency that offers those interest-free loans to homeowners for the water treatment, water testing and water treatment in their house. Remember, we were watching the videos about people with well water, and they get those water treatment, arsenic water treatment systems and such. Well, the state of New Jersey allows homeowners to deduct in their taxes $500 to test their water at least once every 5 years. And they'll give interest-free loans. The NJHMFA gives interest-free loans to people to install water treatment systems in their home if it's provided by well water. Okay. Anyway, loans directly from the government, where the government is supplying the money, would be from the REC-D. That's the Rural Economic Community Development, formerly called the Farmer Home Loan Administration, and that comes from the USDA. So the REC-D, Rural Economic Community Development, is a department within the USDA that lends the money. They give loans to farmers, but also to people just simply who live in rural areas. So the former Farmer Home Loan Administration, that's what that stands for. Okay. Now, because we're talking about terms like this, rural, urban, it'd help if you understand what they meant. So urban, an urban area, see all the dots here? That represents people living close to each other. So you got a lot of people living within a close proximity of each other. that is considered an urban area. A densely populated area is what an urban area is. If people live a little bit further apart from each other, they call this suburban or suburbia, right? And the people who live far away from each other, where you could barely see your neighbor, that's rural. Those are sparsely populated areas, like in farms or out in the country, where you're far from your neighbors, okay? So it's important to understand the terminology: urban, suburban, rural. It has to deal with the population density. So how does lending work? I already explained this, but let's go over it once again really quickly. Most lenders do not lend their own money. Those that do are called portfolio lenders, and the loans that they give are called conventional loans. So page 243, under conventional loans, that's where we're looking right now, okay? Right next to the title, you get them from portfolio lenders or something to that effect. You get them from portfolio lenders. Now, who do consumers get loans from? Where are places where we could get loans from? Well, we get them from banks, credit unions, or investors. These commercial investors would be insurance companies, investment funds, etc. These are some common sources of obtaining funds for loans. A lot of people don't know that insurance companies lend money because they do it through mortgage brokers. But insurance companies have a lot of money, don't they?
Yeah.
I mean, think about it. You pay a lot of money for car insurance?
Too much.
When's the last time you ever had a claim?
Never.
If ever, right? So insurance companies just collect money and they sit on it, waiting for a claim to go out, right? So they don't just sit on that money and smoke their cigars and drink their Cavassier or whatever it is, right? Triple distilled, whatever. Okay, so what they'll do is they'll reinvest that money. As you just saw, when we were doing the math, lenders can make a lot of money, right? So insurance companies use their money to get even richer, okay, by giving loans to people to buy homes that then they insure and they charge them insurance on. All right. Banks lend their depositors money. Now, this is an oversimplification of it. It's not technically 100% correct, but it paints a perfect picture for you to easily understand it. This is why I'm explaining it like this. Banks lend their depositors money according to some third-party investors' criteria. That's their lending guidelines for loans that they're willing to purchase. I told you, the secondary market, those investors will buy the loans from your local bank. So your local bank usually creates their lending criteria to match those of the investor, knowing that if they lend you their depositors money, that they already have somebody lined up that they could sell it to so that they could get the money back and lend it out again. Okay, so then they sell that loan later to get their depositors money back, plus some of the interest paid upfront as profit. Sometimes these investors will also pay the bank a servicing fee to continue doing the collections for the monthly mortgage payments. So that's how your local lender, your local bank makes money, by lending other people's money, selling it, getting some of the interest up front, and also getting paid a servicing fee. Now, loans are originated in what is deemed the primary mortgage market or the primary market. That's where banks originate loans to consumers to purchase the product, the house. Now, when those loans are resold to those investors, that's called the secondary market, where loans that were originated in the primary market are then resold to investors. Okay, It'll be somewhere here for us to highlight that. I think it's in the next chapter though. But this is a good slide that basically explains portfolio lenders give conventional loans that's lending their own money, primary mortgage market, secondary mortgage market, and how lending works. This is a nice nutshell explanation.
Quick question: when an investor picks up your mortgage, do you as the homeowner or the person on the mortgage get notified that that has gotten like sold off to somebody else, or you have no idea? You just continue to make your payments the way you've been doing it forever.
You have to sign a document to confirm the original loan amount, the interest rate, the term, and the monthly payment amount. What is that document called?
Contract. No.
Estoppel certificate.
Okay.
Sound familiar?
Yeah.
Okay. And what is a similar document that the lender who's selling that loan has to sign? It's called a reduction certificate. I know these terms are all still new still, so I don't expect you to have them at the top of your head yet, but I'm trying to build this story now and then pull them in when you're asking questions, right? So now you could see how it actually comes into play. Because you asked, is there some way that you get notified? Well, you have to sign an estoppel certificate. That's your notification.
Okay.
But do you need to be notified in any other way? No. Is the bank allowed to sell your loan without your permission? No, they're not. But they already got your permission. You know when they got it? When you got the loan. You know that stack of loan mortgage papers that you were signing? Well, one of those papers in there was that gives them the right to sell the loan if they want to.
Got it.
Okay. So, that money as debt video, I do have the video, and I have a bunch of versions of it. We just don't got time to play it. But look, this, I think I have it somewhere on our Facebook page, the Career Path Academy Facebook page. Look up money, or you could just go to YouTube and look up Money as Debt, Promises Unleashed 2. Okay, that talks about that. And those who are interested in the newer cryptocurrencies and stuff like that, this guy is coming up with a Money as Debt Promises Unleashed 3, which is talking about investing and new types of monetary systems and stuff like that, like cryptocurrencies. It's a new series. He just started it. He's only got a couple of videos about it. Okay. But this guy created this whole movie. It's like it's actually a 46-minute long. I think I was saying 42 before. It's a 46-minute long movie that's made out of, it's cartoons basically. But this guy is he's an economist from Canada, but he's a world economist, and he talks about how the monetary and financial systems work in the United States and throughout the world. And since the beginning of time, how did banking come about? How did lending come about? That explanation I just gave you of the banks lending their depositors money, are they actually lending out their depositors money? If I gave you a loan, if the bank gave you a loan to buy a car, are they giving you the cash, a wad of cash?
No.
No.
No. What are they doing?
Creating.
It's all done by paper. It's all done through paperwork.
Right. They're just binding you to the amount that you need.
It's a matter of what we call notes, right? A note and deposit slips and transfers of a promise. So the bank just conjures up the money. They don't even have it.
Isn't that credit in a sense?
Well, money is debt.
Yes.
So that's this title, Money as Debt. Well, money is created from debt. I'm not going to do it justice by explaining it to you. I suggest you guys go to YouTube and watch this video, Money as Debt, Promises Unleashed 2. I do have it on our Facebook page if you scroll down far enough. I could also send you links to it if you want. I'll post it again on our Facebook page when I get out of jail. Yeah, I'm in Facebook jail again. So what is a conventional loan? These are loans directly between the borrower and the lender with no third-party involvement or influence. You get them from who? Portfolio lenders. These are the notes that I always dictate to people in class. You guys do not have to be writing this and hurting your wrists right now, but I suggest that you study these pages, these certain pages like this one that explains what the conventional loan is. Now, do not confuse a conventional loan with a conforming loan. A conforming loan is a loan that meets Fannie Mae's lending guidelines. Fannie Mae is the largest purchaser of loans on the secondary market, that they buy loans that were originated by banks. Okay, so conforming loans are those investors. Okay, conventional loans are directly between the borrower, the consumer, and the lender, the local lender. They don't get resold to those investors. So the lender has the final say who they're going to lend their money to. They have more flexibility. I already explained this to you guys before, but now we got it here on the slide. The maximum seller concession allowed is 3% on conventional loans. That's the amount of money that they'll give up to a buyer, that a seller could give to a buyer towards the closing cost. Well, conventional lenders will only allow up to 3% to happen. The owner of a property cannot give more than 3% back to the borrower to help with their closing costs or repairs. Now, typically, they require larger down payments, as much as 20%, although I have seen them as low as 3%. If the LTV is higher than 80%, what does that mean?
Loan to value.
Okay, so what does that mean if the LTV is higher than 80%?
Loan. 20%, you pay 20%.
That means they'll lend you more than 80% of the value of the property. So that means you've got to put down less than 20, right? So anytime the lender would allow a borrower to put down less than 20%, they require that borrower to pay PMI, which is private mortgage insurance. PMI insures the amount, that 20% that they didn't put down, or the amount less than 20% that a borrower put down. So under conventional loans, I want you to write max seller concession allowed 3%. I want you to write max or maximum seller concession allowed is 3% under conventional loans. Maximum seller concession allowed is 3%.
What page is that again, Vic?
243.
Thank you.
Maximum seller concession allowed is 3%. All right. And in the next page, you don't have to write it here because on the next page, they're going to talk about conventional loans that actually it says it right here on this page. So under private mortgage insurance, third line down in the middle, let's highlight with any down payment less than 20%, a conventional loan must be accompanied by private mortgage insurance PMI.
And what does LTV stand for? Or
LTV is loan to value ratio. It's how much money the lender will loan you in relation to the appraised value of the property. So if the LTV is 80%, the lender will loan you 80% of the appraised value of that property, meaning that the borrower has to put down 20% of their own money. You see how I just updated this slide? If the borrower does not put down at least 20%, then they may be required to carry PMI insurance. They have to pay for private mortgage insurance called PMI.
Thank you.
Because if the lender loans you more than 80% of the value of the property, conventional banking theory says that they're risking their depositors' money. Because what happens if the property values go down or something happens? That borrower has little money in the game, if any at all, and it's no sweat for them just to walk away from the loan and say, screw the bank, let them have the house. I ain't paying this. The house ain't worth that no more, right? If you didn't put down any money, right? So this is why the banks usually require the borrower to put some money down to try to minimize that risk of that happening. Because remember, it's risk-based lending. It's all based on the lender's risk. Now, next paragraph, I want you to highlight at the end of the first line. Lenders drop PMI coverage at the borrower's request. Here we go. I got a slide all about PMI here. Lenders drop PMI coverage at the borrower's request when equity reaches 20%, and that coverage be dropped automatically when it reaches 22. And then underline so that you know it's not just one big continued highlight. Equity is the difference between the market value of the property and the amount still owed on it. And beneath that, we're going to highlight a BPO is a broker price opinion. This is a written estimate of value that resembles a CMA, a comparative market analysis. And a CMA resembles an appraisal. Here's the difference. CMA is a valuation that we do for the consumer. BPO is a valuation that we do for lenders. We can't call either one an appraisal because we're not appraisers, right? So what is PMI insurance insuring? It is not life insurance, and it does not insure the entire loan. It only insures the amount less than 20% that the borrower put down when they bought the house. So if the borrower puts down only 5% when purchasing, the PMI insurance would insure the other 15%, the amount less than 20% that the borrower put down. They only put down 5%. Well, if the borrower does not put down 20%, they got to carry PMI insurance. They got to pay for PMI insurance. So if they put down 5%, how much less than 20% did the borrower put down? 15.
15.
So the insurance will insure that other 15%. And the borrower can drop that PMI insurance when their equity reaches 20%. Now, if they don't realize that the equity reached 20% already, the lender is allowed to keep charging them that insurance. But the federal law requires that, but what is the insurance insuring? If you already got 20% equity, what is the PMI insurance insuring?
Ensuring that like the person doesn't just say, no, I'm not going to.
It insures nothing. The only, what does PMI insurance insure? The amount less than 20% that the borrower put down when they bought the house. Now, if equity reaches 20%, the PMI insurance isn't insuring anything because it only insures that amount less than 20 that the borrower did not put down. So the federal law allows the banks to continue charging you that insurance, but only when equity reaches 22%, then they're required to drop it by law automatically. So when can PMI insurance be dropped? At the borrower's request when equity reaches 20%, and they must drop it automatically when equity reaches 22%. Okay, so unlike MIP insurance, which is mortgage insurance premium that's required on FHA loans that insures the entire loan. PMI only insures the amount less than 20% the borrower put down. Because remember, what is an FHA loan? Does the FHA lend money?
No.
No, they insure
Insure
loans.
it.
They insure the lender against loss. It insures the entire loan amount. So the person who gets an FHA loan has to carry something called MIP insurance, mortgage insurance premium, for the entire loan. It's different than PMI. I know it's got the same letters there in a different order. All right. So I'm providing this to you guys. Here's a list of a few local portfolio lenders. Maybe you get a buyer and they need to get a loan, and their credit's not bad, but they, like my friend who couldn't get a loan, who had that excellent credit score, made a lot of money, had a lot of houses, never late on a mortgage payment, but he didn't fit into any lender's criteria. Here's a couple of local lenders that are portfolio lenders for you. RSI, Rahway Savings Institute, Amboy Savings Bank, PPAC Gladstone. Yeah, I know it's a town in New Jersey, but so is Rahway. PPAC Gladstone's another bank. Providence Bank, Unity, Columbia, and Santander. Although Santander usually doesn't give portfolio lenders loans for small loans. They usually fund with their own money large projects, like I'm talking like condo complexes. You know how to find if somebody is a portfolio lender? Here's the tip I'm giving you right here. Look at the top. How to find a portfolio lender. Don't ask the mortgage rep because they usually don't know. They'll be like, oh yeah, we're a portfolio lender, and then they're not. Drive by any construction site where you're seeing a home being built, and if they got a banner or a sign up there that says, this project is funded by, and the bank name, guess what? They're a portfolio lender. Easy way to find out. Okay. So now we're on page 244. We're going to start on this. We're not going to have enough time to finish this today. We got about 5 more minutes left of class. And this section takes a bit longer. Okay. What is an FHA loan? Well, FHA finally has their own website now, by the way. You can always find information about FHA loans on the HUD website, HUD.gov. But FHA now has their own website. It's not FHA.com, it's FHA.gov. Let me show it to you so that you can see what it is. This is the official FHA website now for consumers anyway. You know, for lenders and mortgage reps and all that, you go to HUD.gov, all right, to get information about FHA loans, okay? See, this is for find a housing counselor, find an approved lender, buy a HUD home. What's a HUD home? Anybody know? A HUD home is any loan that basically was an FHA loan that got foreclosed on. And now it's owned, it got foreclosed on. Who foreclosed on it? Well, when you get an FHA loan, what is that? It's a loan given by the local bank. FHA insured that loan. And if the lender if the borrower defaulted on the loan, FHA forecloses on the borrower, and then they pay out the bank, they reimburse them so that they don't lose a penny in the value of the house, because that's their insurance plan. And then they turn the home over to HUD, the Department of Housing and Urban Development, who then sells them as HUD homes. You cannot advertise or call a HUD home a foreclosed home, though. Don't do that. You'll get in trouble, okay? It's not a HUD home. HUD homes are not foreclosed homes, okay? FHA foreclosed on them, then they sold them to HUD. So it's a HUD-owned home. It's not a foreclosed home, it's a HUD home. Tomato, tomato, yeah. but you guys are getting the drift what I'm saying. Okay, now FHA.com is not the government site. It's a bank site. See? It's even cartoonish. I want to go over something really quick before we're done here, though. Okay, so FHA insures loans, but they don't lend money. They insure the lender for the entire loan amount against loss in the event the borrower defaults on the loan. Loans are used for purchasing real estate or for refinancing owner-occupied 1 to 4 family homes. They are not for investors. You can only have one outstanding FHA loan at a time. The most popular FHA loan is a fixed rate loan, a fixed rate 30-year loan called an FHA 203B. So the 203B is their most popular one, but they have adjustable rate mortgages. They got straight loans. They got all kinds of loans available that are out there. Construction loans. Why get an FHA loan? Well, because they require a low minimum down payment requirement of only 3.5% down, which is an LTV of 65.5%. But they do have a repair requirement that the house has to be in livable condition and not require a lot of repairs. Now, what is not requiring a lot of repairs? If you have a house that has paint peeling inside or on the exterior, you're not going to qualify. The house doesn't qualify for an FHA loan unless the homeowner scrapes that paint and repaints it. Because paint that peels is lead paint. Okay, so they're looking out for the homeowner. You're not going to get an FHA loan to buy a house if the front steps are loose or the railing is loose or cracked, or the steps are cracked or the front railing is loose. Why? Because they're assuming that if you don't have enough money to put down to buy a house using a conventional loan, then how are you going to have the money to do all the repairs? I know we get a lot of people that come to us that I work in construction. I could do the repair. I could fix it. I could do this. I could do that. And they probably could. But the FHA is trying to look out for you as the consumer. They're not going to assume that. So the FHA requires that appraisers, when doing an appraisal, also do an inspection of the house, even though they're not licensed home inspectors. They're supposed to look out for certain things of disrepair. And if those things are not right, like the paint is peeling on the house, or they actually have to run a dishwasher through its cycles. If a house has using an FHA loan, has a dishwasher in the kitchen, the appraiser, not a home inspector, the appraiser has to turn it on while they're doing their appraisal and run it through its cycles to make sure it doesn't leak. If there's water on the floor, you can't get an FHA loan. It's the dumbest thing. You cannot get an FHA loan for a house that does not have a stove in the kitchen. It has to have a working stove. So you'll see an appraiser trying to turn the stove on too. All right. The maximum seller concession allowed is 6%. It requires an upfront mortgage insurance premium that's paid by the borrower in case they default on the loan. That MIP mortgage insurance premium can be dropped by the borrower only if equity reaches 78% after you've had the loan for a minimum of 11 years, and only if you put at least 10% down when you bought it. Otherwise, that insurance can never be dropped. So when President Obama left office, he added these things in there. It used to be that the FHA insurance can be dropped after, I think it was 5 or 7 years of having the loan. When equity reaches 78%, that was still the same requirement. He jacked it up to 11 years. You got to have it a minimum for, and you can never drop the insurance if you didn't put down at least 10% when you bought it. Once again, why do people get FHA loans? Low down payment requirement of 3.5%. So what do you think most people put down? 3.5%. So can most people drop the insurance on FHA loans now? No, ever. Why did President Obama do that? Anybody? Anybody? Bueller? Bueller? All right, he did it because he wanted to make FHA a loan program that you use to get into home ownership. And once your equity reaches 20%, refinance into a conventional loan and get the hell off the FHA program. He wants to make it a program that is good to get into home ownership, but not to stay on. If you refinance into a conventional loan, you wouldn't have to pay the MIP insurance, and therefore a cheaper loan. Okay? Why? Because if people stay on the FHA insurance program, if they ever default in the in the future, that's another expense, another payout for the for HUD, right? So it's a risk. It's that you're a risk as long as you have a loan out there with the FHA. So he wants you to use that program to get into home ownership, but then get the hell off of it as soon as possible. Now, with an FHA loan, you may be able to finance some of the closing costs as well. And because of that, your loan could end up being more than 100%. Think about it. What are closing costs? Closing costs are typically, well, 2 to 3%, but it could be more depending on the value of that home, of the purchase price. So the lender could end up lending you more than 100% of the home's value. So any or all of the down payment and closing cost can be a gift, but not a loan from your relatives. Why can't it be a loan from your relatives? We already discussed this with cars.
Because they're going to trace them?
Because if it's a loan from the relatives, then that means you need to pay it back, and it still has to be factored into your debt to income ratio of how much you could afford to borrow. FHA has a loan program called the 203K. You guys, this is what I wanted to get to before we left. You guys will love this one. FHA has a 203K program. This is a type of loan that allows one loan to cover both the purchase price of your house and extensive rehabilitation work. Remember, the 203B type loan, the most popular loan, you can't get a loan to buy the house if the paint is peeling. But what if you buy a house and you want to do some massive rehabilitation? You want to remodel the kitchen or put an addition on the house or do some work to it. Well, you could get their construction loan. This is their version of it's not construction, that's an incorrect term. It's a rehabilitation loan. But the way I remember it is 203K, K for construction. I know it's not spelled that way. So what is considered extensive rehabilitation work?
Like remodeling the whole kitchen?
Or putting an addition on the house, right?
Yeah. Or fixing the roof.
Let me show you something else. You're gonna love this one. I got pictures. I got pictures of a house around the corner from me that used one of these loans. Ready for this? You're gonna love this. Come on, open up picture. What is this that you are seeing in front of you?
They tore it down.
That looks like a garage, a wall, and a chimney, yeah. Which eventually they tore down this wall and chimney too. It was just the original garage. They tore down the entire house.
So they got to rebuild the whole house is considered.
Look at this. Look at this. They tore down the entire house. Look at that.
Yeah.
That's where the house was in between. Here's the garage. Here's a wall. They eventually tore down this wall too. They didn't tear it down at this point when I took this picture because they still had the main electric hooked up there. The electric power company had to come still to disconnect.
Super extensive.
No, hold on a second. Not only did they tear down this entire house except for the garage, they dug the basement deeper and further into the yard, basically doubling the footprint of the house. Now,
And they were allowed to do that? Like,
well, what's extensive remodeling? I just said, right?
I mean, yeah, that's
Now watch this. Watch this. I got pictures at all stages here. Okay, so that's the picture.
So that was okay, but that's okay.
Yeah. It's an old builder's trick too.
shit.
I'm gonna watch. So this is the house, and then they started building this. Look at that house compared to this one. That's still in the construction phase. Look at the size of the house compared to the neighbors.
Oh yeah. Wow.
This is getting closer to the end of the construction here. All right, look at this. This garage does not have anything above it. This garage has a bedroom above it. Oh, by the way, this house is about this deep. They built this house that much deeper. So they doubled the depth of the house. They dug the basement deeper. They put an entire second floor on it with dormers on top of that. So this house is actually 3.5 times the size of this house with square footage.
Wow.
Wow.
Now,
That's unreal.
it's an old builder's trick. How come they didn't just tear down the whole house? Why did they leave the original garage there and build the house around the garage?
Because you have to make an improvement. You can't tear it down completely.
They have to leave one original wall standing and build a whole new house around it. And if there's one original wall there, it's not new construction, it's a home improvement. And so as far as the tax department is concerned in the town, if these original houses here were built in 1940 something or 1950 something, as far as the tax record's concerned, so was this house.
Wow.
It was remodeled in 2021.
The one wall is the oldest thing on
Right.
on
Here's
the
what-
house.
Here's what it looks like today. Here's what it looks like today. Now they got the steps up and all this. I took this the other day. Looks a lot better. But damn. So this house, according to the tax department, as far as they're concerned, this house was built in 1950.
And now, do they still consider that a Cape Cod?
That's not a
Because
Cape Cod.
that's like
That's definitely not a Cape Cod. That's definitely not a Cape Cod anymore. But it has a basement, a huge one. It's got the garage built in. It's got the basement. I wonder if that's a tandem garage because they built it so deep, or if they have rooms behind the garage too. I don't know. Interesting. Anyway,
Smart. That's so smart.
so as far as the tax department is concerned, that house was built in 1950. They don't know to raise the taxes on that property.
What about
Most municipalities in New
they
Jersey.
have to apply for permits to do all that stuff.
I was just about to talk about that.
yeah?
Most municipalities in New Jersey, the building department does not talk to the tax department, even though they're usually next door to each other or across the hall from each other. They don't talk to each other. I think you could count on one hand how many municipalities in New Jersey where the building department actually communicates with the tax department. Nobody ever accused government of being smart or efficient. Holy shit, right? Isn't that
Yeah.
crazy? That's
Yeah.
crazy. Oh my God, that's excellent. Though. I love that. I love stories like that. But anyway, that's not for investors, this is for private homeowners, this FHA 203K program. Now, hold on. I think we're past the time, but let me just go over something else here I want to get to. In the book, I don't have it here on my slideshow, but in the book, it says that FHA, if we look at the bottom of page 244, you see where it says estimate of value? We're going to have to highlight a bunch of things on this page. We'll do that on Monday. But on the bottom of page 244, in the second paragraph, highlight where it says FHA allows down payments as low as 3.5%, because we're going to have to highlight that anyway. Now, don't highlight the rest of that sentence, but let me read it. And will consider applicants with credit scores as low as 620. All right. Why? Anything below 620 is considered subprime and is considered to be, well, it's subprime means it's not prime. Prime is
Ultra high risk.
is where you get those advertised credit, the interest rates. Like if you see an ad on TV about, you know, this lender is offering loans at this interest rate, and you call up and you want to get that great interest rate, you can't qualify for it. You only get a higher interest rate. It may be because your credit score is not prime, and that credit score is for prime people with prime credit scores only. It's a ranking. That's subprime. It basically means a poor credit score. Okay. Check this out. That's false. Most lenders won't give an FHA loan that is subprime below 620. But check this out. Remember that website I just went to by mistake, this FHA.com? Check this one out. Let me scroll down just a little bit, because I've went to lenders like this before. FHA loan requirement as low as 580 credit score. It shows you it's BS. 620 is not an FHA. That's not an FHA standard. That's most lenders' standard. That's an additional requirement the local lenders put in. Okay. This particular lender, just like there's several others out there like that, that they lend money to people with a little higher risk. So 580 credit score and only 3.5% down. Huh. So there you go. So take that with a grain of salt. All right. We're definitely not going to be finishing this chapter today. We're already done for the day. So we'll continue this chapter another day. So let me